climate-related risks.
I'm Bonnie Quinn with the First Word News. The number of Americans who have died of COVID-19 is about to surpass the number killed in the 1918 influenza pandemic. The U.S. has reported more than 673,000 deaths since the beginning of the pandemic. That's according to Johns Hopkins University data, just shy of the 675,000 that are estimated to have died a century earlier. Many health experts say the milestone was avoidable after the arrival of vaccines. The U.S. will soon reopen its borders to most foreign travelers as long as they're fully vaccinated against COVID-19. The White House said the new measures will also involve stricter requirements for coronavirus testing and contact tracing. It's part of sweeping reform of strict entry rules imposed on visitors to the United States to try to curb the spread of the coronavirus. The new rules take effect in November. Dry, gusting winds will sweep across Northern California earlier this week. That could aggravate a blaze that threatens to torch iconic sequoia trees across the Sierra Nevada and leave thousands of homes without power. The wildfire began September 10th after a lightning strike. It's already destroyed more than 21,000 acres. Workers have been wrapping the trees in aluminum foil to protect them from flames. In Canada, Prime Minister Justin Trudeau gambled on an early election in an attempt to win more seats in Parliament, but today's vote could cost him. Polls indicate Trudeau's Liberal Party is in a tight race with Conservatives. It's expected to win the most seats in Parliament, but still fail to get a majority. Trudeau is betting that Canadians will reward him for navigating the coronavirus crisis better than most countries did. Global News, 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Bonnie Quinn. This is Bloomberg.
The most crucial moments in the trading day. This is Bloomberg Markets The Close with Caroline Hyde, Romaine Bostick, and Taylor Briggs.
Counting down to the close, and we've just got an out today of this day of trading.
Yeah, it's setting up right now to be one of the worst sell-offs we've seen all year.
Yeah, and Romaine, you've been putting a lot of size and scope here pretty well for us. Only six stocks in the S&P. I think I saw 0 in the Dow. And so you really get the perspective of what a broad-based sell-off looks like when you take a look at some of the individual sectors. This, of course, being the S&P 500. It is, yes, red across the screen. I guess on a relative basis, you have some of the bond proxies as the relative outperformers. And it is the reflationary trade that is clearly under pressure today.
Yeah, well, as we speak, only about 10 stocks in the S&P 500 are in the green. I put Pfizer up there because it was in the green before I walked over here, now ticking into the red, and this is really the downdraft we've been seeing all day. When we started the day, it was a pretty broad-based sell-off, but you had about 100 or so names that were still in the green. That dropped to about 50, and now, like I said, we're basically below a dozen names right now as we head towards to the close here. Obviously, a lot of the materials companies have really taken it hard. You had the big sell-off in iron ore over there in China, and pretty much everything in that sort of materials space, particularly with industrial metals and industrial chemicals lower here. Albemarle, of course, a big lithium maker. Caterpillar getting dragged down as well. Obviously, a big part of its fortunes tied to mining as well here. And then even Blackstone here, you're actually seeing a lot of the private equity firms. No real reason here other than just sort of a broader risk-off sentiment, but really emblematic here of just how this is really a sell everything type of day. Blackstone down 9%.
The bad kind of breadth,
yeah,
as you were saying, the bad kind of breadth, which has people now sat on the fence. Is it that we're going to see a further sort of correction? Could we get to the 10%, 20% levels? Or is it a buy the dip moment? JP Morgan making that call on the buy the dip. Morgan Stanley saying that we could have further to fall here. Mike Wilson was on earlier, of course, the CIO and chief US equity strategist for Morgan Stanley. Here's his take.
Corrections are always about price and time. And so from a price standpoint, I think it's 10 to 20%. Great. But time, I think you've got to get through the third quarter earnings season. Let's see how the revision breadth kind of plays through that. Let's see how the market digests the Fed moving towards tapering by year end. So to me, it's sort of 2 to 3 months. You know, I think you've got to be patient in here. Let's see how this goes into basically the fourth quarter.
Brave man to try and make the call of when exactly we're going to have that sort of correction. But for now, all those down days, they add up to more than a 5% move, Romaine.
Yeah, Mike Wilson, of course, always smart. Our next guest is also smart. Joanne Feeney, partner and portfolio manager for Advisors Capital Management, joining us right now to walk us through what's going on here. And I want to start off, Joanne, with the general sentiment in market and, more importantly, what the expectations are by investors here, because we've seen in the past, at least in the past year and a half, investors really shrugged off some of these sell-offs and pretty much jumped in to buy the dip. But we're now down 5% here from that all-time high, something that we haven't seen in quite some time.
Yeah, Romaine, this is reality, I think, coming to roost. Investors have had a really nice ride, and they sort of forgot that the market does tend to pull back a few times a year in general. This is the first time we've seen it in a while. But, people have to put this in perspective. And I think that the near-term focus could be the downfall of investors, right? You want to look through this and make sure your portfolio is positioned really for all eventualities. And I think a lot of people are still sitting on really concentrated positions, and they need to make sure they have aspects in their portfolio that'll do well when the economic recovery does return, which it will, because we're still in the early stages of that. We have a lot of risk right now, and that's really starting to disturb, some of the stock valuations. But ultimately, put it in the bigger perspective. Economic recovery is happening, right? Earnings are very solid, and we have, because of all the shortages, we actually have a longer runway for this recovery to take place. It's not that V and one and done, and we're back to where we started pre-pandemic. This is going to take a little while, and some positions, say like a Broadcom, can give you a really nice dividend yield while you're waiting for that growth momentum to pick up again.
Where are you buying, of course, given some of the valuations that have come down, as you mentioned, in the last few trading days?
Yeah, what we'd like to build into our clients' portfolios is three elements. One, the secular growth names. Broadcom is one of those. We still like some of the bigger names like a Microsoft, but also some of the lesser known names that also could afford some growth for the longer term, like a Sea Limited out of Southeast Asia. And we also want some cyclical names in there really for the recovery, whether it's a bank like a Citigroup, or some of the industrials that have a secular component like a Train Technologies. Also gives you an international position to help defend against potential rise in the corporate income tax rate. And then also really defensive positions, whether that's a General Mills or a Philip Morris or a Darling Ingredients. These consumer staples can really provide some protection during these kinds of volatility periods.
Joanne, we always love how granular you get in giving us individual names. I'm interested that you made the call of protecting yourself against U.S. tax concerns when you also say they go for international stocks, even those related to Southeast Asia. And I'm interested in how much of the ripple effects of China could consume those companies that are exposed in some way to the Chinese supply chain.
Caroline, I think a number of things are happening, right? Clearly, China is a concern. And one has to, in order to invest in China, recognize what really drives the politics over there and its long-term goals. And so while there's certainly been a lot of regulatory crackdown, that's hurting these stocks in the short run. And then obviously the recent news on the real estate front for China, I think has less of a contagion risk than some people think. And really, I think what's driving international stocks right now is just the COVID situation. And that, it's going to take longer for economies around the world to recover. So from the U.S. perspective, we're in a pretty good place, getting better. We're going to see another wave of reopening momentum here in the U.S. And then as those vaccines really reach the far corners of the world, we will eventually see that the afterburners of the recovery for the U.S. in terms of some more export-driven growth. So, international stocks are a good place to defend against the corporate tax increase, and they're a good way to get into the afterburner growth that we think is coming, maybe 6 months or a year from now.
But there's still going to be a little bit of a hurdle with regards to psychology here, Joanne. And I wonder how much of that plays into it, not only psychology for individual investors and clients, but also the portfolio managers out there. Most of these people are sitting on some pretty healthy gains here. You're talking about an S&P 500 that doubled off of those March lows, and even on a year-to-date basis had pretty much posted up some pretty significant returns. So when you see these types of pullbacks, does that sort of create a psychology where you just say, let me just pull my money off of the table, or take the profits, I should say, and wait this out?
Well, Romaine, people have to ask themselves, where are they going to go? It's always hard to time the market, right? In fact, when we look at what individual investors do on average in terms of an annual return over, say, a 20-year period, they only get about 2.5–3% annual return because they do jump out of the market when they get scared like this. And that's probably the worst thing to do. And right now, you can't even run into fixed income because you're not going to get much return there. We do expect rates to rise and so bond prices to fall. So you want to be a little bit more defensive in your equity positions, and you really want to be careful about being overweight some of those positions that did so well over the last 12 to 18 months. So our, strategy is to, own companies that have good secular growth that can ride out these kinds of market cycles and that psychology you referred to, and also to generate, for folks that are, say, in their retirement, generate some income-oriented positions so that they can feel a little bit better about riding out, this kind of volatility.
The perfect voice for today, Joanne. Thanks for joining us. Joanne Feeney, Partner and Portfolio Manager for Advisors Capital Management, just with the calm access and focus on this market. Meanwhile, coming up, we continue to keep a close watch on the sell-off. We'll do it calmly, though, too. We've got the closing bell with David Balin, Global Head of Investments and Chief Investment Officer for Citi Global Wealth. And rate decisions galore. The FOMC, the BOE, the SNB, Riksbank and Norges Bank, plus central banks in Brazil, Turkey, Indonesia, all holding monetary policy meetings this week. Well, that, so much more, as well as cryptocurrencies taking, a beating along with other risk assets today. So much for them to be a diversified trade here. We'll discuss how the ripple effects of China perhaps sweep through all of the global markets. This is Bloomberg.
This is the countdown to the close, 47 minutes to go here on this Monday afternoon, and this is the bona fide sell-off. A lot of people said that they were looking for, well, you got it today. The S&P 500 right now, right around the lows of the day. If it closes at this level here, we're going to be just shy of that 5% drawdown. We haven't, of course, had a true 5% drawdown on a closing basis since November. Right now, we're roughly at about 4.9%. The Dow Jones Transport, so something to keep an eye on here. Remember, it hit that all-time high back on May 7th, and it's been weaker ever since. It's now down more than 12% from that all-time high, and today, based on the price we're at right now, is actually at risk of closing below its 200-day moving average. The first time it would have done that, basically since the pandemic sort of started back here in the U.S. in February of 2020. The MSCI Emerging Markets Index, the risk-off sentiment, it has been seen there for quite a few days now, down for a fifth day in the past 6. And of course, you see the flight to treasuries. Flip up the board, take a look at some of the individual movers. A lot of that, of course, has to do with what's going on in the materials space here. Cliffs Natural Resources and Freeport-McMoRan. Lower here, of course, the big iron ore maker and, of course, big copper producer. Obviously, a lot of the concerns about China and, more importantly, the stability of the property market and what that might mean. I also promise you, of course, one bright spot, American Airlines, actually one of the few stocks here that is in the green. That's on the lifting of some travel restrictions. And some breaking news crossing the wire just now. This on Activision. Blizzard, of course, the big video game company. Dow Jones reporting that the SEC is investigating Activision over workplace practices. Activision also says it is cooperating with that SEC probe. Again, this is based on reporting on the Dow Jones Newswire. Of course, that story has been unfolding for some time here. But we do want to get back here to the broader market and the sell-off that we're seeing and bring in Abigail Doolittle now for our Options Insight segment, which we have every day at this time, I should say, Abigail. And, of course, this time it's a little bit different here. We've got a pretty broad sell-off here. This obviously seems to be tied to a lot of the concerns, the macro concerns.
Indeed, it is certainly a big sell-off. At one point, I think actually even right now, the worst sell-off since October of last year. So that sell-off that you were talking about, that pullback that everybody wants, they have it today. But I would argue it's not out of nowhere, because if you were to tie it into Evergrande, China's shares, of course, have been selling off since February. That divide has loomed large. But I would also like to bring in expiration day last Friday. Chris Murphy was talking about this, actually. And I'm looking right now back at 2020, that March 2020 expiration day, which brought so much volatility the week after, and that Monday. But the next day, there was a 9% bounce. So sometimes it just takes some time for situations to even out. Let's bring in Lune Rosen of Oppenheimer to see whether or not you alone believe that some of the volatility that we have today, because the question is, why today? The Evergrande situation isn't so new, the chip shortage isn't so new, the Fed isn't new, but options expiration, some of the sloppiness that could follow it from last Friday, that could be a factor today. Do you think that we could see any kind of turnaround action tomorrow?
Hey, Abigail, great to be back. So I think it's what we've been talking about for a while now. If you look back 3 weeks when we spoke, it's a lot of the factors that are just coming back to fruition. We know about China. People knew about the credit situation. It's not new. It's another excuse to sell. We know about labor shortages. It's getting worse. The semiconductor shortage is getting worse. I'm trying to buy a car now. It's very difficult. It's very expensive. And people think that's effectively going to hit growth at some point. So it doesn't matter about the bonds. That's getting the safety bid. We're just seeing risk off, a lot of degrossing before the quarter end. Many funds and investors have decent or very respectable year-to-date profits that are finally looking to book. So we've been looking for this type of move, and it's always vicious when it happens.
Yeah, Alone, let's bring in that point about taking profits and a reason to sell, because so often folks want a reason for the sell-off. But to Romain's point, off of the March 2020 lows, these indexes are a double. So, in terms of booking profits, it certainly is a compelling idea. And sometimes it's just a matter of more sellers than buyers. What are options telling you, as opposed to those fundamental reasons that everybody wants the story to fill in?
Right now, options are showing you a lot of fear. The skew level, the out-of-the-money put volatility relative to upside is back near February 2018 levels, or we haven't seen this type of rise as far as the difference is concerned. And that's when we had a volatility shock at the time with the VXX type of product. Right now, fear is definitely out there, and that's probably the only bullish thing going on for the market. But we're in a situation where many people are caught a little longer than they want to be. It's been very difficult to hedge this tape. You look at last week, we kept bouncing and bouncing. Expiry was a factor, and a lot of that defensive posture that was supporting the market came off on Friday. So we're looking for a little support maybe into the Fed on Wednesday, but very choppy ahead. And there's support on SPX 4250 is our next stop we're looking at. That's spot 425, a couple percent lower here, or not even.
Well, finally, Alone, interesting comment right there, that fear is the only bullish thing that the market has going for it. Do you mean that today's risk-off day, the pullback, and if you combine it with the last couple of days, because I think the S&P 500 now is actually down for a third day in a row, down 4 out of the last 5 days, right now on pace for a third down week in a row, the worst month in a year, so that's a lot of down, yet it's still not that 5% pullback. But do you think that all of that is a reason to see a sudden snapback of some sort? Are you seeing that in the options?
We're seeing effectively more volatility being priced in, so a 1 to 2% daily move could be a lot more common into this week. Right now, I think it's a 50-50 bet on the next 2% up or down.
Let's bring
Very tough call here.
You were just talking about skew on stocks. Let's bring in very quickly the skew index, which I know a lot of professionals don't like because it hasn't been so reliable. But over the last couple of years, the skew index has in fact predicted the 2020 bear market. It also predicted the 2018 fourth quarter sell-off, and even that 2016 correction, or some even call it a brief bear market. What do you think about that skew index, that far out of the money put buying near a record high? Does that scare you?
It does. It means that we really could see the air pocket continue to come out. We've all been waiting for this for a while, and effectively what this is telling us, until we see it back down, it might be harder to bounce strongly until that fear factor and the skew relieves itself, and we're not seeing that just yet.
Air pocket, great phrase there alone. That really does describe, because today's S&P 500 action to the downside and the Russell 2002 gaps to the downside. Let's see whether or not that 100-day moving average on the S&P 500 can hold. Alone Rosen of Oppenheimer, thanks so much for joining us for Options Insight today. And from New York, this is Bloomberg.
We get back to the big story of the day, and of course, it's not only the news overnight in China with Evergrande and some issues there starting to bubble up, but really some of the contagion effects that we continue to experience here. One thing we should note, this is the Hang Seng Property Index. You're now touching some new 5-year lows. This is after Romaine quizzed me, and I think I got this right. High yield debt in China, 14%. Evergrande bonds, 111%. That is not basis points, that is percent. Let's continue this emerging action conversation with Sherry On, the co-anchor of Bloomberg Daybreak Asia. And we talk about the Hang Seng Property Index. And you talk about what Damien Sassower sort of corrected us earlier is it's not the micro. This is a macro issue now. What does this mean for China stepping in, for China not stepping in?
Yeah, because when we first started looking at Evergrande, we thought, okay, this is a huge company, tons of liabilities, assets impacting different parts of the economy, but it was still an Evergrande story. Now it seems to be more like, is this really going to affect the real economy in China, given what a big impact it will make to the property sector? Then what will that mean for China, given that it's so important for global inflation, for commodities demand as well? We have a very important week coming up for Evergrande. Interest payments on 2 Evergrande notes coming due on Thursday. If they don't pay within 30 days, that could be seen as defaulting. We know that the government has stayed on the sidelines, right? They have recently hired advisors to look into Evergrande. The PBOC injected a little bit of liquidity into the banking system last week, but there have been no real assurances about what's going to happen with Evergrande. We have a great opinion piece by John Author saying that still, this doesn't look like a Minsky moment like the likes of Lehman Brothers. It could be more of an implosion of long-term capital management hedge fund. Yeah. Back in 1998, the Federal Reserve stepped in, they cut rates. Will we see this in China, given how big of a systemic risk they posed? We're talking about them being a whale in the credit sector, about 16% of those high-yield dollar debts coming from China.
Okay, so everyone, the world watches really as this crisis continues to circulate over in China. And the world watches also a lot of other catalysts that come its direction, because there's not just the PBOC we wait on, but there's the Fed and actual proper monetary policy meetings happening this week. What else has the emerging markets on tenterhooks?
It's a storm this week, isn't it? Because Evergrande, a huge week. We have the FOMC, but then we have all of these central bank decisions. At least when it comes to developing market central banks, the consensus is that we might not see big change. But perhaps that could be a reason why we could be surprised this week, right? It looks like the wild card could still be Turkey. Their decision coming on Thursday. We know how President Erdogan feels about the need for rate cuts and how they've been struggling with inflation as well. So we'll be watching that closely. We have already seen, as that chart shows, yes, these are the futures linked to the MSCI Emerging Market Index flipping to net shorts for the first time in more than a year. We have emerging currencies also at around that 200-day moving average. We have Indonesia Central Bank decision tonight. But yeah, not a lot of change in the Asian monetary policy side of things.
All right, where do you go for stability in this world right now, Sherry?
This is a tough one, and we do have a Bloomberg article talking about Mexico having a lot of stability. That the MXN. I'm not sure, because MXN has been under pressure today. I know, right? I saw that. It's like, yes, it seemed to be up until now, but then given the week, the magnitude of the week, we are seeing MXN under pressure. Still, though, over the past year, gaining 1% against the U.S. dollar, political stability sort of there, considering their peers in LATAM. Also, we have to be careful that other LATAM central banks may be increasing rates soon, so that could really mess up the differentials and the strength in the peso.
I'm feeling Sherry's trying to tell us it's all relative. Meanwhile, Sherry Ann, of course, is the co-anchor on Bloomberg Daybreak Asia. You'd want to catch her a little bit later as we continue to cover this global market rout. S&P 500, well, falling by the most in a couple of months, but we saw Europe lower, Asia too. This is Bloomberg. I'm Bonnie Quinn with the First Word News. The number of Americans who have died of COVID-19 is about to surpass the number killed in the 1918 influenza pandemic. The U.S. has reported more than 673,000 deaths since the beginning of the pandemic. That's according to Johns Hopkins University data, just shy of the 675,000 that are estimated to have died a century earlier. Many health experts say the milestone was avoidable after the arrival of vaccines. Here in New York City, students will have to undergo COVID testing every week instead of every other week. Mayor Bill de Blasio made the announcement today after 77 classrooms were closed and one school was shut down due to the virus. The city is also relaxing its student quarantine rules, allowing continued attendance if students are masked and at least 3 feet apart from anyone who is infected. The new rules take effect next Monday, the same day that all teachers and school staff must show proof of vaccination. House Democrats will include a suspension of the U.S. debt ceiling in a must-pass spending bill needed to keep the government open past the end of this month. It's a risky move that assures a showdown with Republicans. The debt ceiling would be suspended through December 2022. Without a shift in position by one of the two parties, the decision leaves the U.S. on course for a government shutdown and defaults on federal payments as soon as next month. Lava continues to flow slowly from a volcano that erupted in Spain's Canary Islands off the coast of Africa. Some 5,000 people were evacuated. Officials say they don't expect any injuries or deaths, but say the lava will destroy everything in its path. The lava is moving about 2,300 feet per hour in a mostly unpopulated area. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Bonnie Quinn. This is Bloomberg.
The most crucial moments in the trading day. This is Bloomberg Markets The Close with Caroline Hyde, Romaine Bostick, and Taylor Briggs.
We are counting you down to the close. Less than 30 minutes to go until this market closes.
Yeah, and a significant sell-off here, getting close to that 5% threshold a lot of people have been looking for.
Yeah, and it really is right on the screen, not only on some of the headline indices, but underneath the surface, the internals don't look pretty as well. You could say on a relative basis, some of the bond proxies are the outperformers. You're off 0.7 to 1.2% on utilities and real estate. Typically do better when yields fall. Though on the bottom side, Romaine, I mean, it's all of the cyclical trade, materials, financials, energy off 2.5 to 3.5%.
You know, there was a good statistic that Abigail Doolittle trotted out last week, and it was really about the number of stocks that were already in correction territory even before we got to this proverbial. This is like the real correction, Taylor, the 10% we're talking about. Apple share is actually down 9% now from that all-time high, which they just hit 2 weeks ago. So this is a stock that slid basically 9.4% based on the pricing right now since basically 2 Tuesdays ago. And you got a lot of other stocks, not necessarily as heavyweight as Apple, but a lot of other stocks that are basically in that 8 to 10% range here, sell-off basically going back to late August here. Tesla down here, down 6.6% here on the day. Remember, it had rallied several days leading up into this. This is actually some of the macro concerns, but there was, of course, also that report out of the Wall Street Journal about some concerns here by investigators into the company's self-driving system and some of the investigation that's looking into that. And one of the bright spots, I'm trying to find any bright spots here. Brooks Automation, of course, is a big chip equipment company. It was going to split into two, but now it's going to sell off the chip equipment business to Thomas H. Lee Partners for about $3 billion in cash, and then it's going to retain the rest of the business, which is kind of a life sciences business, which the company seems to think is going to be the future, and that will be where most of the growth is. Investors seem to think so as well. Those shares up 8%.
Hard to find a bright spot today. When you've got moon music such as this, there was a great story put out by Kriti Gupta, really talking about some of the technicals at play today. And this is a great chart. And it basically shows how painful things were from the very start of trade. This is your sort of tick index, as it's known. This is basically how you measure the direction of travel, whether all stocks are moving, whether a certain amount of stocks are moving in the same direction at the same tick. And this is uptick minus downtick. You're seeing we hit a new, well, not a new low, but the second lowest low. When we see in May, it was, down negative 2069. We're now negative on the open 2067 today. So clearly the moon music, the sentiment, it was ugly at the start of trade, Taylor. It looks like it's not pretty good at the end of trade either.
Yeah, and really doesn't look good cross-asset either, Caroline. You've been talking a lot about Bitcoin also being swept up in some of the global sell-off. Analysts believe, of course, China's Evergrande worries could be the reason. Let's bring in Bloomberg cross-asset reporter Katie Greifeld for more in. Katie, of course, we know the volatility. Okay, you're down 9% on the day to 43,500 on Bitcoin, but it really is the correlations, the store of value, that this is the reason we hold it, because it's not correlated to anything else. Do days like today make some crypto enthusiasts maybe question that?
Yeah, I mean, just looking at the price action today across assets, it's really clear that that uncorrelation narrative didn't quite work. Because, I mean, if you really dig down, Bitcoin trades more like a tech stock than anything else. We had a great story on the terminal today showing that actually, if you look at the 30-day correlation between Bitcoin futures and the NASDAQ 100, it's been pretty consistently positive since February. So to see stocks sell off in a big way today, you're going to see that with Bitcoin. If you did want to make some sort of fundamental case about Evergrande, we know that China isn't thrilled about crypto. We know that they've cracked down on mining and on trading. Obviously, they've been more concerned with other sectors right now. Real estate is in the limelight, but spotlight could swing back to crypto. But really, I think today is more just about this broader risk-off vibe.
Yeah, broader risk-off. And I do wonder, I mean, we talk about these correlations, we try to sort of make this case that Bitcoin offers something of a hedge or of some sort of correlated value to the rest of the market here. I mean, if you scale up the drawdown that we're seeing in Bitcoin today, which is something like 8% drawdown here, I mean, that's really not in lockstep with what we're seeing in the broader equity market here. It just makes me think that this is completely divorced from not only the market, but probably reality.
It is more dramatic, and that really has to do with the fact that Bitcoin is more dramatic than equity markets.
Yeah, it's a little extra, right?
It is a little extra. And
8% is nothing, right?
It's nothing. I mean, it's less painful than what we saw a few weeks ago, that 17% drop in one day. But what's interesting about Bitcoin and why even when it tends to follow stocks, takes its cue from stocks, you tend to see these liquidity cascades that you don't see in other markets. You see people forced out of their position. We have some great data from Byte, which shows that 258,000 traders had their accounts liquidated over the past 24 hours. The stat amounts to about $1.3 billion worth of crypto. And you tend to see these stats in any big crypto sell-off, that it starts as this sort of, orderly sell-off, and then you see it feed upon itself. People get forced out of their positioning, and you just have to see all the leverage get cleaned up pretty much.
And then that's a good thing, right? Is how it goes. Oh, good. We've washed out the leverage. We've stopped perhaps some of this cross correlation where everyone's holding collateral in other cryptos, and a buying opportunity again.
Exactly. I mean, if you talk to analysts, if you talk to investors in the space, they always make that case that once you sort of clean everyone out of
everyone says it in stocks too.
Oh, of course,
a healthy drawdown.
Yeah, now positioning is much more clean. We did see that last time though, when we saw that big sell-off that took us below 40,000. We rebounded right back up. We were above 50,000 for a while. Now remains to be seen. I heard some people saying, if you just look at the charts, if you look at the technicals, we could get down to $40,000 a coin here. And then it's really anyone's guess, because you do have all of that leverage flushed out.
Yeah, 43,600 right now on Bitcoin based on pricing here in the U.S. Bloomberg cross-asset reporter Katie Greifeld. Let's check back in here on the broader market here. We're off the lows of the day. That's the good news here. You are seeing a little bit of a dip, buying here. Guess what? There are 28 stocks in the S&P 500 now in the green, Taylor. Can you guess what the number one mover is to the upside?
No.
It's an airline.
Delta,
American.
United, American.
It's because, guys, Europeans can come back into the US
I know,
at some
I'm told.
point.
Yeah, this should be a boon for some of the local economy.
Romaine, you tested me earlier, I said that I passed, and I think I failed. Let's do it. Let's do a good market close correction here. You were right. When we were talking about fire and ice, the fire still was a modest and healthy 10% correction. There you go, Romaine. I stand corrected. Happy to admit.
So no more corrections today?
For a little while.
A little bit more ways to go.
This is Bloomberg. minutes until this market closes, and is the worst day in a couple of months for the S&P 500. Very few companies in the green at the moment. We're seeing at last maybe that 5% pull down hit its level. We're seeing it off by 93 points in the S&P 500. But this is a global sell-off. We saw money pour out of Europe in particular, out of Asia as well. We're off by 1.9%. Remember some holidays in Asia, though, at the same time. Is that adding to the volatility? Money goes into the havens of choice. Of course, the dollar, bonds, Bloomberg Commodity Index sinks. Iron ore, of course, another concern regarding China. David Balin's with us, Global Head of Investments and CIO for CC Global Wealth. Going cross-asset for us, but to start with us on equities, David. And this market sentiment, this pulling out at the moment, will it stop? Will we see dip buyers as soon as tomorrow?
Well, we could see buyers tomorrow, but what I think you're seeing here is really this idea that somehow what's happening in China, and specifically what's happening with Evergrande, is somehow going to be a global contagion. And there really is no data to suggest that that's the case. The size of this actual default, which has been anticipated, by the way, since last week, is not especially large relative to their local market or relative to even their regional market, for bonds. And so this is the idea that somehow this is going to be a worldwide contagion. And that's happening at the same time. We have lots of activity in Washington, D.C., and activity around the Fed as well. So I think this shows you that investors are concerned with a sort of sell-first mentality. But when you look at the fundamentals, there's not a whole hell of a lot to pin this day's move on.
Yeah, not really. And I mean, it seems like some people are just kind of looking for an excuse for this pullback. I am curious, David, a longer term here. I mean, this is a market that has done pretty well here. I mean, obviously more than doubling off of those March lows from last year here. And there was some concern here about stretch valuations. And I'm wondering, where do you see, I guess, sort of the next, oomph in this market that could push it higher? Is it going to come from corporate earnings? Is it going to be more the economic data? Where?
So, Romain, I think you're going to see contradictory information that's going to then lead it higher. Given what's happened with China's slowdown, which is actually real, and of course with the fact that the Fed is eventually going to taper, and with the fact that we are going through this situation with COVID and with Delta having risen and now fallen again, that is all having a real impact on a slowing down in the economy. What we're talking about is slowing down from 6.5% to 6 or 5.5%, right? Which I think is something we can clearly handle. So to answer your specific question, Romain, when we look ahead, what we're going to see is that once people start focusing on 2022 earnings, you're going to see broad earnings up between 10 and 14%. That's going to make valuations look less expensive than they are now. And I would argue in some sectors they're rich, but in many sectors, especially in value sectors, in healthcare, you can find plenty of value in the U.S. market with that kind of expectation. I think there's an emotional quality to where we are in the market today, where people are taking individual data points and they're projecting out. And they're saying, well, look at the correlation. Everything's correlated. That's just for a day. We have to look at how markets are going to behave over a long period of time.
All right, we got a lot more questions for David. David Balin's sticking with us, Global Head of Investments and CIO for Citi Global Wealth. We're counting you down to the closing bells, 43.40, down 2% on the S&P 500. This is Bloomberg.
is Countdown to the Close. I'm Caroline Hyde.
I'm Taylor Riggs.
I'm Romaine Bostic.
Let's check in on what has been an ugly day for every benchmark. But, I mean, we're starting to try and, well, dare I even say, buy this dip. But we're certainly coming off of our lows. What is in charge? Well, it seems to overall be some of the NASDAQ, sort of the big tech has been your least of the laggards, but really this has been an overall sell across every industry group today.
Yeah, absolutely. But some dip buyers coming in here. We're well off the lows of the day. Flip up the board here, and you look at some of the indices here. The transports here, I really wanted to focus in on that here because we're down about 12% from that all-time high set back in May. Remember, the downtrend on the transports has been a long downtrend now for a few months, and they're actually at risk right now of closing below that 200-day moving average for the first time in this cycle, basically since the COVID crisis took a leg out of most of these stocks back in February of 2020. You're seeing bank stocks, of course, under pressure, really getting battered around by the macro concerns and less, of course, by some of the concerns with the yield curve. And then, of course, you look at the FXI here. These are the main ETF traded here in the U.S. of the largest Chinese companies. Remember, Chinese markets were closed. Hong Kong was open, but mainland indices were closed here. It'll be interesting to see what happens when they reopen. But right now, you're seeing the investor reaction here in the U.S. definitely negative to the downside. And the pharma index is actually higher on the day. Pfizer and a lot of the names were actually moving higher here on some optimism here about booster shots and some other sort of data coming out with regards to giving vaccines to younger and younger children.
Yeah, let's do all of this and more with David Balin, Global Head of Investments and CIO for Citi Global Wealth. And David, talking in the last segment about sort of what this sell-off means, put it into perspective for us in terms of valuations. We're off about 4.3% from some of the recent highs on the S&P. And from the fundamentals and the economics, is this a better entry point if we think that the economy is, well, not going to slow too much further from here?
Well, when we look at how to head to next year, we definitely think earnings are going to be materially higher, 10 to 14% higher than they are now. We think that valuations, are going to be more reasonable next year as a result of that. And there are sectors like healthcare, which you touched upon earlier, or the internet sectors, where growth is going to continue to happen regardless of what's going on in China at the moment. And so I think for equity investors, we are potentially in a buying opportunity. But when a market goes down by 2%, that's not the opportunity. It's completely normal for markets to go down 3 times a year by 5%, 1 time a year, by 10%. These are normal. We're just not used to it. The markets were up prior to today, 18% for the year so far in a pandemic economy. So we're consolidating. Investors have to deal with the fact that there's an enormous amount of news out there. There's China, all the events that are taking place in Washington, events associated with worries about inflation. The economy is slowing down, what the Fed is going to do. That's all happening at the same time. When we sort it all out, though, and we look to next year, we are going to be in a growth mode. We are going to see consumers spending. We are going to see businesses investing. And we are really at the beginning of a new second phase of the economic cycle post-COVID. And I think people have to take that into account.
David, what's interesting, I put out a correction on myself, full of them today, but it was actually the chart that we showed earlier were actually the futures market, so it was slightly different colors than I'm usually used to. But it was actually, big tech has been your key laggard, as has the Russell 2000. So small caps and big tech sort of lagging, where the Dow is off by 1.9, right? The S&P at the moment off by 1.8. All of them ugly. But is there a sector that you would therefore bet on? Can you go as broad-based as that, or do you have to get even more granular? Do you have to stock pick in this particular market?
Yeah, I think you definitely want to, Caroline, to do sector picking right now, right? Because the sectors that have nothing to do with this, you take a look at home builders, you take a look at healthcare, you take a look at internet. What do they have to do with any of what's taking place in the news today? And the answer is absolutely nothing. So those are the areas of the market where if you're going to want to hold those stocks for the next 2 years or 3 years or beyond, these are good opportunities to buy it. The areas that are obviously going to be most impacted by something like this, and you've touched upon this, are some of the areas of commodities, areas where we're going to see weakness in the event that China's overall economy slows down more than we expect. You have to look at fundamentals in that regard, and so I think to your point, these are opportunities for considering where to diversify, especially when things get hit unnecessarily.
David, we got a big Fed meeting coming up here in a couple of days here, or at least a big announcement on Wednesday here. Is there anything here that you think would actually change some of the narrative that we've already had sort of baked into this market with regards to the taper, the potential for a taper, and of course with regards to whenever liftoff might be for interest rates?
Right. So, Romaine, it's so interesting to me that you bring that up, because what's going to happen now is that there are these excuses for waiting for the tapering, right? The first excuse really was how many people are going to get reemployed. And then there were these numbers that didn't look so good a month ago, and that looks better now. And then you have this, a crisis of confidence in China and stuff like that. At some point, the Fed is just going to begin that tapering, begin buying fewer bonds. And as that does so, the normalization of the market is going to take place, and shorter-term rates are going to rise as a result of that. And the yield curve could, in fact, flatten in that environment. The question for us is, what is ultimately the story for inflation going to be? We do expect higher inflation in the next 10 years than the last 10 years, let's say maybe 2.5%. And then investors have to decide, are they willing to accept real negative rates of 1 to 1.5% a year? Are they willing to lose 15 to 18% of the value of their money by not being invested? And once they decide that that's an irrational thing to do, we think there's another wave of money that can come back into the markets as we exit this year and enter next year that could be very attractive and supportive for equities.
All right, in conversation right now with David Balin, of course, Citi Global Wealth, Global Head of Investments and CIO. He's sticking with us as we count you down to the close. And of course, Taylor, as we talk about the rates, you have to also talk about home builders. Believe it or not, we're getting earnings after the bell.
We are. They're going to come a little bit after the bell here, closer to the 4:30 time. But nonetheless, Lennar, of course, my stock of the hour, shares are off 3%. You're off with the broader market. But of course, some of the fundamentals that we'll get after the bell are, of course, the supply and the demand constraints, some of the inflationary pressures that are underway for the housing market. Look at revenue topping $7 billion, net new orders, the more than 16,000, and full year deliveries estimate going forward of about 63,000. So those are sort of the big headline numbers that we'll be looking for shares of Lennar, my stock of the hour. Change up the board, and David, we've been talking a lot about this. I'm going to fold this chart and go cross asset with you. It is the market and it is the strategist price target, which strategists have been really bullish. And a lot of people were saying that, no, we need some people to come in on the other side. We need people to be a little bit more bearish here. And I'm wondering what this confirms with you, particularly as you go cross asset and some of the FOMO that you're seeing in the equity and the credit markets.
Yeah, I mean, I think that, when you have a line that looks like that, you've got to believe that there are people who are looking for points of consolidation to take profits, especially into year end, especially with tax law changes available. But again, investors who've got a 2 to 3 year view should be looking at what earnings are for 22 and 23, and there people should be confident. They should hold their portfolios broadly, and they should reallocate to sectors like healthcare and certain of the internet sectors which can sustain their growth and sustain their earnings into those 2 year periods.
All right, David, always great to catch up with you. David Balin, Global Head of Investments and CIO for Citi Global Wealth, helping us count down to the closing bells here. Seeing a little bit of a dip buying going on here as we get closer to that closing bell. And of course, as always, we bring you full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Taylor Riggs counting you down to the closing bell, here to help take us beyond the bell. It's our global simulcast team. Carol Massar, joined today by Ed Ludlow, in for Tim Stanovic, bringing together our Bloomberg television, radio, and YouTube audiences. And Carol, this was, I guess, maybe potentially the big pullback that a lot of folks were looking for, though, seeing a little bit of dip buying coming in as we get closer to that bell.
This is what's been fascinating to me, Romaine. I just keep watching that as stocks take a leg down, all of a sudden you see those major equity averages come up again. And yes, significantly so. The S&P down 2.9% at its lows. Now we're looking at a decline of about 1.6%. Michael Sheldon of Hightower RDM just telling Ed Ludlow and me that we haven't had a 5% pullback in some time. So it's understandable, Ed, that we might see some pullback, but he's still pretty constructive on the markets.
Yeah, he was talking about opportunity, that cycles don't come in quarters, they come in years, and there's a lot of growth still to come in certain sectors.
I mean, phenomenal amount of action in terms of volume coming back to the market. When you're just looking at your average volume versus the last 20 days, we're up 40%, 41% on the S&P 500, more than 50% on the Dow. So real action taking place at the moment in the markets.
And we've heard a lot of strategists coming into this saying that look at the credit markets, and there were no glimpses of big FOMO, that of course spreads are historically tight, but a lot of this had been supported by fundamentals, by the health of corporate balance sheets. So Romaine, when you think about what the equity market and going cross asset, you haven't seen a huge blowout in spreads despite the headline full faith and credit declining 5 basis points on the day.
It'll be interesting to see what the market reaction is over here over the next couple of days, of course, both in terms of whether folks are willing to come in and buy this dip tomorrow, but also you have the Fed meeting on on Wednesday and how that might change the narrative. Remember, at one point on the day here on the S&P 500, we had basically almost every stock in the index down. There were only 3 stocks that were actually higher, and it looks like we're going to end the day with about 50 of those stocks higher here. That may not sound like much, but that's certainly a huge improvement from where we were a little bit earlier here. Right now, you're looking at a Dow Jones Industrial Average. Looks like it's going to close the day down by about 614 points, about 1.8%. The S&P 500 right now down about 75 points, or about 1.7%. We should point out at one point it was down about 2.7%, and from that that September 2nd high, that almost amounted to a 5% drawdown. It was basically about 4.9%, so just shy of that 5% drawdown that we haven't seen since November of last year. The NASDAQ composite down about 2% on the day, 330 points, and the Russell 2000, Carol, down 2.4%, 2182.
So crucial, and you know the technicians, Romain, are going to be weighing in on this big time, is we have seen so much buying come into the market over the past year, particularly as we saw major equity averages hit those 50-day moving averages on the downside. So again, going back to Michael Sheldon, the conversation, he said if we pretty much close at that 50-day and kind of hold, that'll be a very significant sign, Taylor, in terms of how investors feel about the equity market.
You know, Carol, we often laugh at you when you put some of your decliners in your gainers board, and now is your chance, because it is red across the screen for me on the sector winners and the sector losers. It is all red, even in the winners category. So let me just walk you through the relative outperformers, though you're still off 0.2 to 0.5%. For a radio audience, it's utilities and real estate. So when bond yields are falling, these typically do better. So that's really what you're seeing on a relative basis, though it is still very much in the red. Let's migrate down to the bottom, because this is where things get really interesting. A lot of this is media and technology. You're off 2.5%. Typically, that's been really defensive categories in this pandemic, but you go down and you see banks, energy, auto, semiconductors. Those are off anywhere from 3 to 4%, as you're seeing some unwind, at least today, in that cyclical reflationary trade as well.
All right, be kind to me, because unfortunately, a name that was in the green big time, Insight. I know, I keep refreshing my Bloomberg, hoping it's going to go back into the green. Insight was up. In general, like a lot of the biotech numbers, names were, we saw some gains in that sector. There were some FDA decisions that are coming tomorrow, so we did see some play there. Insight, though, was up 4.6%. Forgive me, down about 0.1% here at the close, but do look for FDA news tomorrow on one of their topical treatments for dermatitis, so we'll look for some movement there. Seagen, another biotech company, top in the NASDAQ 100, up 1.8%. That was a gainer. They presented some interim data for one of their treatments for metastatic cervical cancer, some optimism there. And I just got to mention American Airlines up 3% in today's session. White House announcing easing restrictions for travelers from the UK and EU. I know you got some news there.
Yeah, I'm just going to jump in here. Sorry about that, Carol.
No, that's okay.
Shell apparently nearing a deal to sell assets to ConocoPhillips for about $9.5 billion. This is based on reporting from Dow Jones here. These are assets down in the Permian Basin here. We'll dig a little bit deeper into it to figure out exactly what they're selling and why. But again, this looks like about a $9.5 billion deal. A big deal for Shell, but probably even bigger here for ConocoPhillips. Ed?
Yeah, I'm looking at decliners. Coinbase down by the most in a few weeks. Lowest since August 3rd, though, and this drop comes as we see cryptocurrencies, including Bitcoin and Ether, lower. But also, it's dropped its own plan for a lending platform where users would get 4% interest if they lend their coins. The SEC has nixed that pretty promptly. Also seeing Chinese ADRs lower. No surprise, given all the narrative out in the market about contagion. But Pinduoduo, the Chinese e-commerce platform, being a particular victim of some of the sell-off we've seen around those concerns in recent weeks. And lastly, Invesco down pretty significantly, almost 10%. Of course, we've got that report on Friday from the Dow Jones that is in talks with one of State Street's asset management units for a merger, according to unidentified sources. So another stock to watch going forward.
Yeah, some great ones to be focusing in on, Ed. I'm looking at what you should look at across asset right now. Let's go into the FX moves, because this is a search for safety, my friends. Apparently, look, traders were saying that volume wasn't massive. This wasn't like a sudden run for the hills, but you did see the yen up 0.5%. You did see the Swiss franc up 0.5%. You did see Australian dollar long dollar index as well, up 0.1%. So this is looking at strength, of course, of the US dollar ahead of the Federal Reserve. Remember, we've got something like 6 key central banks giving their monetary policy outlooks for this week alone. So plenty of nervousness in the market, particularly when it comes to foreign currencies. The pound down 0.6%, Canadian dollar lower as well. Why is the Canadian dollar lower? Why is the loonie lower? Because of what's happening in commodities. And we did see the sell-off across the Bloomberg Commodity Index. Crude off by 1.5% as we question growth, as we worry about China, as we see natural gas, interestingly, down in the United States. But if I had my closed markets up here, you would see phenomenal moves in gas in Europe and the UK, up 15-16% on the day as that energy crunch, that crisis continues. Let's look at where there is also a flight to safety. It is in the haven of bonds. Yields lower across Europe. What about in the US, Taylor?
You're certainly seeing bonds catching a bid in full faith and credit, Caroline. Yields are falling really across the curve, 3, 4, 5 basis points. But earlier, this was trending more towards 5 to 6. So if we're going to nitpick, you could say maybe you're off the deep lows of the session when you talk about yield. But overall, it really was sort of a risk-off, bonds catching a bid kind of day. Excuse me. There are some other key technical levels, of course, Carol, when we talk about the 10-year yields. But you fold those into the S&P as well, and really, though, classic range bound that we've been in the past few months. Though on days like today, it catches your attention when it goes all back to the flight to quality.
Well, I do feel like this is a time where technicians are dusting off their charts, looking at some of their analysis and trying to decide, okay, wait a minute, are we developing a new trend line here? What does it ultimately mean? But I do think many will say it was significant to see some buying into the close here, certainly in the U.S. market. I'm going to be curious about the China open and Asia market open in just an hour or so here, Romaine. But I do wonder, this is what happens longer term. The Fed meeting is going to be crucial. Maybe tomorrow we have a little bit of a wait and see mode as that 2-day meeting kicks off.
Yeah, and I think that's probably going to be even a bigger factor here. I mean, there's obviously going to be some short-term opportunities who might come in and buy this dip. But if you're a longer-term investor and you're looking for an entry point, you probably want to wait to see what comes out of that Fed meeting, what they signal with regards to that taper and how that might sort of fold into your general outlook.
Interesting views from different sides of the street, though, today, because we have Mike Wilson from Morgan Stanley, sort of taking the glass half empty kind of viewpoint. Look, we could be sitting...
Fire and rain, right?
Fire and ice, wasn't it? 20% you could see on the downside. We love a little bit of grandiose statements coming over from certain pockets of Wall Street.
Who sang that song?
Fire and ice.
Fire and rain, Romaine. James Taylor.
James Taylor.
Quickly Google.
Caroline continues.
But on the upside, and to go talk sunshine and rainbows right now, because JP Morgan had, of course, they were earlier calling it was a read spike on the Bloomberg a little earlier, saying, look, the stock rout is overdone, dip buy. So we have got two very different viewpoints.
Did they use the phrase sunshine and rainbows?
They didn't, sadly. I wish they had. That would have been some nice,
Come on, Ed. Are they doing that out on the West Coast? Sunshine and rainbows?
Guys, there is no sunshine in San Francisco, as Caroline well knows. It's cloudy most of the time. And you know what else is cloudy? The fiscal policy outlook. Because this isn't just about the Fed tapering. It's about the pullback from the US government and the stimulus they brought in temporarily. And how far are China going to go clamping down on a real estate industry that was the driver for growth in the first place? That's what we've been asking guests all day long.
And you wonder how much of this is the tax policy and some of the debt ceiling crisis that you've been alluded to. And the markets really up until this point, Carol, had been shrugging it off. And you do wonder if taxes and some of this is now coming back to the forefront.
No, it's a really good point. Rich Miller on the Bloomberg, check out. Had mentioned that all of the federal government programs that pumped so much money into this economy, that's the other tapering that he's kind of concerned about, and people are watching, Romaine.
Absolutely, but I mean, it's still I think you have to sort of pull this back towards what's happening globally here. I mean, obviously, it's not just about China, but I think when you see the reverberations going through the commodity space, when you see the flight to some of those haven currencies, and of course, when you see the reaction in bonds, it's still at this point, people are still willing to re-embrace U.S. Treasuries here when things get skittish. I think it says a lot here about investor sentiment. We can't sort of forget, too, that the VIX had quite a wild ride today, actually, right now around 25 and change.
And it's only Monday, guys. We got lots more to come this week.
And it's UN week. You think they'll address this?
I don't know. Well, we will certainly talk about it if they do. All right, guys, that's going to do it for the Monday edition of Beyond the Bell, live on Bloomberg Radio, Bloomberg TV, and on YouTube. We will catch you tomorrow, same time, same place. So much going on.
Well, I tell you, bring up UN week, Romain.
Yes.
We're going to be sitting down exclusively with the Irish Prime Minister. He's in town, remember, with the United Nations General Assembly. So brings plenty a global leader who is willing to take the flight. We're speaking with Taoiseach, the Irish Prime Minister, Mr. Martin, in a moment. Stick with us. This is Bloomberg.
All right, the S&P closing down for the 9th time in the past 11 sessions. This was one of the broadest sell-offs that we've seen going back for a good portion of the year here. Bloomberg Markets reporter Kriti Gupta joining us now to help break it down. And Kriti, pretty much at the start of this session here, it looked like it was going to be a bad day.
Absolutely, and it all started off with macro risk, really kind of the straw that broke the camel's back. But there was so much going on underneath the hood. A lot of it had to do with technicals. Remember, we've been hitting these record after records with really tiny breath and trying to bounce off this 50-day moving average that's really been in the spotlight for 2 weeks now, and still it broke below. So you had technicals, you had this macro risk coming from Evergrande over in China, and on top of that you had this really tiny breath, really kind of functioning as a coiled spring, for lack of a better term.
Quickly here, Kriti, ripple effects, cross assets, credit spread, CDS. Any ripple effect?
Yeah, possibly. I think right now the question is more on the macro front. You see all the sell-off, this cash coming out of stocks. It went right into bonds, 6 basis point move right before the U.S. stock market opened, and still bouncing back. So for sure, there are ripple effects. The question is, how long do those ripple effects last?
Bloomberg Markets reporter Kriti Gupta, so great to break it all down for us. We also had some other big breaking news in the last few minutes. Bloomberg's Alex Steele joins us now. And Alex, I mean, wow, Shell nearing a deal to sell assets to ConocoPhillips for $9.5 billion. Put this into perspective for us.
It's a really, really, really huge deal. So we knew that Shell was looking about putting on their Permian assets on the chopping block. They already sold their oil sands project in Canada, so this is kind of the next step to go. Bloomberg had reported that they were considering doing that. Potential bidders back in the day were Conoco, Devon, and Chevron. Now, Chevron went off and bought Noble on its own. That was about $5 billion in an all-stock transaction. Now, Devon hasn't bought anything in that respect, but it did wind up merging with another company. Now, Conoco already spent about $10 billion buying Concho to beef up its resources in the Permian Basin. So this would be another enormous deal, one of the biggest shale deals we've ever seen, and Conoco will be responsible for 2 of them.
Yeah, and just real quickly here, Alex, why does Shell really want to shed this?
So Shell is under an enormous amount of pressure, as with a lot of European oil majors, to change their business model. Remember that they lost a Dutch court ruling that is pressuring them to cut emissions faster. They also basically want to become a power company at the end of the day, and this may not fit into their business model in the same way that it would for Conoco.
All right, a big deal here between ConocoPhillips and Shell. Alex Seal, of course, who hosts Commodities Close. She also hosts, of course, the European Close, and we want to stick on Europe right now and push ahead to tomorrow with the United Nations 76th General Assembly kicking off right here in New York City. Caroline Hyde standing by with a key voice ahead of the event.
Yeah, because of course today remain a story of energy, a story of global market turbulence, a story of investors eyeing economic risks from Fed policy in the US, China credit crunch, energy crisis in Europe. It's time for a global discourse as well, and they get a take on the daily and the longer-term economic challenges, fretting on COVID, climate, inclusion. That's what political leaders are here to do, in person and virtually at the UN General Assembly here in New York City. Prime Minister of Ireland is with us, Micheál Martin, joining us in town, exclusive conversation in the flesh. And what's so wonderful is we were just discussing energy deals there. This is a time where I look at gas prices in the UK and Europe up 15-16% today. This must be something that you're coming to town to discuss with other geopolitical leaders, is basically a climate crisis but an energy crisis upon our hands. How is Ireland dealing with that at that moment, that blackout risk, those energy prices spiking?
Well, in the first instance, we will manage it over the next while. I think the key agenda item for Ireland on the energy front is wind, and we've been great developers of onshore wind. The next decade in Ireland will be offshore wind, and we have streamlined our planning application framework for investors so they have certainty in terms of applying to invest in terms of offshore wind infrastructure in Ireland. So that will be a key agenda item of ours, and renewables. We have a very strong climate component in our government and in our government programme, and that of course is not disconnected from the energy agenda, and there will be challenges of that, there is no doubt, but we are making considerable progress.
Are you worried about the here and now? Are you worried about blackout risks? Are you worried about the amount of consumption data is taking up in Ireland?
Data is taking up considerable demand in energy terms, but we have been robust in terms of meeting that to date, and I'm confident that we have the right mix to maintain that sort of robust response. I mean, for us, the two key pillars of the next stage of economic growth is digitalisation and climate and the green economy. So our investments are targeted, as we emerge from COVID, towards the green economy and towards digitalisation. And we've got to try and marry the two in respect of the various challenges that will arise from them. And COVID has taught us many lessons and has accelerated some of the push on the technology front, particularly in terms of the delivery of health services. And also, we think, has given people a closer connection with nature and an appreciation of existential threats. That COVID has created that in terms of a pandemic and a virus. People now have a greater, I think, understanding of how near now that existential threat climate change represents than perhaps they may have had prior to COVID.
So talk to us about net zero by 2050. Will Ireland achieve it?
Yes, and we've passed a climate law in Ireland, which sets very ambitious targets of reducing emissions by about 51% by 2030 and net zero by 2050. And that is a very strong commitment of ours across every sector. And by the end of the year, we will be publishing carbon budgets for each individual sector, from transport to agriculture and to industry. And we have to move fast as a country, and we have set very challenging targets, but we are absolutely determined with our European Union colleagues to achieve them.
Let's talk about the digitization focus then of the economy. How important is your 12.5% tax rate for digitization, for the fact that it helped lure Google, Facebook, so many key technology companies to want to put their headquarters, European headquarters in Ireland? Are you committed to that 12.5% level then?
Well, first of all, it has been a very important part of our broader range of tools to attract companies into Ireland. But it's more than that, I have to say. I think the human capital in Ireland has been a very critical part of those companies' success stories, both on technology and indeed in the life sciences as well, in advanced manufacturing and so on. And we've built up a lot of strengths in that area, and also in terms of our migration approach, being part of the wider European Union, we have a large talent pool of people who want to come to Ireland to live and to work and to enjoy good quality of life. That's very important for the Googles of this world, for the Amazons and the Apples and so on like that. And remember, Apple came in the 80s, have transformed, just like they've transformed in America, they've transformed in Ireland as well, and play a huge critical role for its European and EMEA operations. But on the corporation tax, we're part of the OECD process. We've engaged in that process constructively, have been since 2013 with the BEPS process. We haven't joined the consensus yet. We've remained one of 6 countries. We've been broadly supportive of the process, but we haven't signed up to the consensus yet because of some aspects of it which we believe do not give certainty or continuity. And in terms of those companies you've mentioned, and indeed others, overall what they require is certainty into the future and continuity. It can't be a scenario where it can change every 2 or 3 years, and that's something that remains to be discussed within this process.
So if you could get certainty and clarity, is at least 15% palatable?
Well, we have concerns with that language and that phraseology around at least, because that doesn't give you certainty and doesn't give you continuity. And there are other aspects as well that we're continuing to engage with our OECD colleagues on.
So what would be the right number?
Well, I'm not going to give in the middle of the...
go on.
We are in the middle of negotiations right now and discussions and so on, and there's a broader engagement with other countries. I don't think you really expect me to do the negotiations there publicly.
I'm horrified that
I know you are, yeah.
Okay, but that conversation is ongoing.
Yeah, it's a serious conversation, and we're engaged constructively in relation to it.
Do you worry that you might be sort of a pariah in some way, be left outside if you don't?
We're conscious of our competitiveness. We believe the issue of competition has to be there. It can't be dismissed. Many countries can sign up to this quite easily because they will be beneficiaries. For Ireland, it does have challenges, and therefore we're taking it quite seriously, and we're engaging robustly in the discussions around it. But again, we are part of the international community. We have been constructive players. Our taxation system is utterly transparent, and you can see what is on the table there. We have an independent revenue agency which is independent of politics and of government, ruthlessly so. And our bona fides with the OECD is accepted.
Let's talk about being constructive. Are things constructive at the moment between Ireland and the United Kingdom in terms of how we're seeing, dare I say it, Brexit unfold, and indeed the Northern Ireland Agreement, the protocol in which we see trade at the moment become a really problematic situation?
Yeah, I think Brexit has been problematic overall in terms of the relationship between Ireland and the United Kingdom, and particularly within the context of Northern Ireland and the peace process there and the respective differences among the traditions within Northern Ireland. There was a majority in Northern Ireland against Brexit. The problems were unique because of the Good Friday Agreement. The protocol that was reached and agreed was one to support the Good Friday Agreement and to underpin it. Now, the Irish government and the UK continue to engage, but the European Union does as well. And the European Union has said very clearly to the United Kingdom, and indeed to us, we want to be flexible. We want to be solution-driven. And the Vice President of the European Commission went to Belfast last week, met all of the parties, and I think demonstrated his capacity to be a problem solver here. But the United Kingdom need to get on board with this process. They've indicated to me that they will. But I'm in no doubt about the degree to which the European Union wants to be in the business of solving problems.
Does the UK?
I think that remains to be seen. I have been assured that they do, to be fair. And I've had engagement with the British government only quite recently, and I've had good discussions with Boris Johnson, the Prime Minister. I get on personally well with Boris. I made it very clear to him and to the British government that they need to engage with the same approach that the European Union is, because we cannot allow it to become an issue that undermines the progress that has been made in Northern Ireland. And also, we can't have it undermining what has been a transformative journey in terms of the relationship between Britain and Ireland over the last 30 years. A journey which the United States has played a key role in facilitating. I mean, the United States' role in the Irish peace process has simply been immense. From President Carter right up along the line, President Clinton, and right through President Bush and President Obama and others, and President Biden to this day now. He's been very constructive and helpful in terms of keeping the focus on getting the problem solved.
Talk to us about other challenges, shall we say, that maybe Brexit has added to, but in general, post-COVID world has, supply chains. How much is this front and centre for you that you're having to think about at the moment? What are the biggest headaches that this new COVID disjointed global supply chain has thrown Ireland's direction?
The global supply chain worries me somewhat, although we've rebounded quite well. The FDI sector in Ireland, or the life sciences technology, have done very well. And in many respects, COVID has been a factor there. You know, we do a lot of medicines. We do a lot of that in Ireland. So the exports have been quite high. Q2 growth has been 6%, fastest in Europe. And so predictions are good for the end of the year. The supply chain worries me. I think Brexit is still a worry. I think COVID has masked the impact of Brexit, particularly on the British economy. And in terms of supply chains, apart from the COVID supply chain issues or related issues, there are Brexit-related supply chain issues that have yet to be fully manifested, if you like. And many suppliers in the UK are finding it difficult. And patterns of trade are changing fairly quickly.
Yeah. House builders, key among them. And Taoiseach, this is the last question to you, and we're about to have this conversation about housing inequality. And Bloomberg editor, bureau chief over in Ireland, wrote so eloquently about sort of the worries of housing inequality in Ireland, how that has been a force of strength, particularly for some of your political adversaries, the people across the aisle from you, because they've said what they want to do in terms of affordable housing and policy.
Yes.
How are you tackling inequality? How are you tackling housing inequality?
Housing is the biggest crisis facing Ireland, and indeed many economies and societies. Home ownership has been a key central plank of Irish life and society, the idea of anchoring people in their community, and then that gave rise to very strong community bonds. So for me, and I'm over a year in government now, we have introduced an unprecedented Housing for All package with unprecedented state intervention to underpin both social housing, where we'll provide housing to people who cannot afford it, and also supports to people to enable them to buy houses at affordable prices. A lot will depend on getting supply up and getting construction at higher levels. And that will be challenging where you have an economy that's roaring back post-COVID, with savings being released into the market and a strong consumer bounce and so on like that. So we are worried about capacity constraints would be our bigger concern. That said, we have the policy platform now in our housing policies to tackle what is a very key issue for our younger generations in particular, who need to have what previous generations had, the capacity to access housing at affordable prices.
Taoiseach, it's been a real joy having you here, coming exclusively into our studio as well to do it in person. It's a real honour, so thank you so much for spending some time with us. Micheál Martin, of course, the Irish Prime Minister.
Thank you very much indeed, Caroline. Really appreciate it.
Enjoy. I think it's Friday that you speak at the UN.
Yes, indeed. Yeah.
Enjoy that speech. We'll be tuning in, of course. We want to thank him so much for joining us here in the studio. Romain, back to you.
All right, great interview there, Caroline. Of course, that's going to wrap up our coverage for Bloomberg Markets to Close, but don't go anywhere. The topic that they were just talking about there with the Prime Minister, housing inequality. Taylor, obviously it's an issue over there in Ireland. It's an issue right here in the United States. We're going to talk with Adina Heffetz on the What'd You Miss here, the CEO of Divvy here, about sort of an interesting way to buy homes. And we're going to also talk to Destin Jenkins, this is right on your wheelhouse here, about muni bonds and sort of how it's actually maybe kind of contributed to some of the inequalities.
A great conversation with all of these. Really excited for that conversation, as well as you think about how American cities have been formed. We're doing it all next. This is Bloomberg.
Visit tonal.com.
From Bloomberg's World Headquarters in New York, I'm Caroline Hyde.
I'm Romaine Bostic.
I'm Taylor Briggs.
All right, guys, and today we had lots of market volatility out there. The S&P 500 down for a third straight day, having its worst day since May, and now we're going to actually get some earnings, believe it or not. Lennar, the home builder, of course, going to report just momentarily here. We'll dig into those numbers, and we're also going to dig into how skyrocketing housing prices, both here in the U.S. and around the world, are adding to a lot of concerns here about inequality. An entire potential generation of U.S. home buyers here at risk of being left behind. Taylor, what are we starting with?
You know, Romaine, we're getting earnings here from Lennar, and frankly, the numbers don't look good. Let's take a look at third quarter revenue, 6.94. Estimates were 7.25 billion. Third quarter net new orders coming in about average 16,277. Estimates were 16,244. So that looks like an improvement here. But you think about an adjusted earnings per share right in line, 327. Estimates of a 326. Let's talk about some of that forward guidance, because you're talking about fourth quarter home sales, the gross margin, 28%. That's right, really here in line. Fourth quarter deliveries, though, looking a little bit light, and new orders also looking a little bit light. So you could say pretty much across the board, maybe starting to feel some of the supply chain pressures, Caroline, and maybe some weakness coming through, given home prices are at record.
And I mean, exactly says that in the statement. The CEO, Stuart Miller, talking about his executive chairman, saying, adjusting our fourth quarter delivery guidance to more or less 18,000 homes, reflecting supply chain constraints. So they say overall supply chain challenges, we believe, will continue into the foreseeable future. So therein lies your lumber issue, I suppose.
And we're going to do a lot of this and some of the inequalities, of course, as this relates to, but we are going to take a look at, well, sort of that broad-based market sell-off as well that we got today. Let's do it all with our Bloomberg cross-asset reporter, Katie Greifeld. And Katie, when you think about, well, one of the bigger property owners in China as well, you cannot ignore what today meant for Evergrande in China stemming over the weekend.
Yeah, and it was interesting to really see this come to the surface in U.S. markets, since this story has been brewing for a while. And that was my first question to investors, to analysts this morning, was why now? Why are we seeing the S&P gap lower today? And the answer I got was that people were looking for a chance to de-risk. You know, we have had the market seemingly going straight up. We ran into some volatility last week. But if you think about the wall of worry we're approaching, weakening earnings forecast, we have the Fed this week, it made sense to take a little bit of profit. That was the reason that we saw it happen today. And that's why you saw the S&P 500 fall almost 3%. But as you can see on the chart, we saw some pretty healthy dip buying into the close. Still closed negative, of course.
All right. Well, since Taylor didn't ask you this, I'm going to ask you about high-yield bonds and some of the spreads that we saw. Well, but usually you kind of, in all seriousness, you kind of see this sometimes as a proxy for that risk-on, risk-off sentiment. And it didn't really kind of signal risk off today, did it?
No. So even though you did see this cross asset sort of wholesale de-risking, you didn't see it really budge the high yield bond spreads, which is where really that's where stress in the market starts to show up. So if we look into it, we still see high yield spreads sort of near they're not quite at the lows that we saw earlier this summer, but getting closer to there. And I was talking to people about this. Why aren't high yield spreads moving? You do see some movement in commodities. Typically that translates into high yield returns. And the reason I got was that basically this isn't yet a U.S. story. Yes, we are seeing obviously a lot of contagion risks here, but the fact that high yield spreads aren't moving, that's a signal that maybe you want to buy the dip. If we saw spreads widen further, that would definitely signal that there is some stress here.
So this is just a China story, is that what they're saying? And until we get any worries from the Federal Reserve later in the week, it remains China story?
There are spillover effects, obviously. I don't want to make that, cross that bridge. But if you look at what was selling off today, I mean, if you look at the iShares MSCI Emerging Markets ex-China Index, obviously that doesn't have any China exposure, still fell 2% today. You saw Twitter, which isn't accessible in China, it fell as well. Kroger, it also fell over 1%. That's a U.S.-only chain. The things that we saw sell off today, some of those things, it's not an exact tie to China. That feeds into the story that, okay, people were just looking to take chips off the table today.
Maybe they'll put them back on tomorrow. We'll see. Katie Greifeld, always great to have her expert analysis. Meanwhile, coming up, we're going to be switching gears a little bit more, discussing the housing affordability issues. We were talking, of course, Taoiseach from Ireland, about the soaring levels of prices across the board, what it means for pushing people out in terms of ownership. Adina Heffetz is with us, CEO of a company working to change that, Divvy Homes. It's next. This is Bloomberg.
All right, today we are focused on housing inequality on the show today. Of course, it is a global problem. It's a U.S. problem, and it's getting worse here, Caroline. I mean, you talk about just the ability of just regular people to buy a house, to buy a house where they work, to buy a house where they want to live. It's just getting harder to do that.
Harder to do that when, of course, the costs are going up, when we've got input costs going up, labour costs going up. And it's been like this for years now, though. My good old United Kingdom has seen, I mean, for the last decade, the price point, if you're dividing it from income ratio, OECD house price to income ratio, the percentage change from 1995 to 2020 in excess of 100% in the UK, New Zealand nuts, Netherlands, Canada. I mean, basically nowhere in developed world left untouched to a certain degree. Let's dig into all of that in terms of like the inequality element of all of it and how you can fix it. Adina Heffetz is with us, co-founder and CEO of Divvy Homes, a rent-to-own housing startup. So Adina, talk to us about how you're trying to make what is seemingly so out of reach for many a little bit more in reach.
Sure. First of all, let me say thank you, Carolyn, Taylor, and Romain for having me on today. So the focus of Divvy is really providing access to home ownership for everyone. Our view is that mortgages have become more challenging to get over time, and so there has to be an alternative to provide people an on-ramp. So what Divvy provides is a rent-to-own product that allows renters to actually build equity in their rental property, get the benefit of appreciation, and roll on to a mortgage when they're ready in the future.
What are customers telling you about how this has helped them and some of the affordability issues that it has helped solve?
Sure. So the way that I think about it is pre-COVID time and then post-COVID time. And so what we've seen post-COVID is that there's a couple of effects that are happening. The first effect is there's rising home prices. And you touched upon this earlier, or Carolyn did. The reason why home prices are rising is, one, we did not build enough inventory for a very long time, so supply is really constrained.
Two, demand has really spiked, right? No one wants to live in a single family. No one wants to live in a multifamily apartment studio during COVID. You want a backyard, you need more space, you need an office. And so demand for housing has increased. At the same time, it is actually more challenging today to get a mortgage than it was pre-COVID. Now, why is that? And the reason why is because most mortgage originators are focusing on refinancing. Because rates are so low, most of the volume they can do is actually refinancing volume rather than new home purchase originations. As a result, it's become quite a bit more challenging for people to actually get a mortgage post-COVID time period.
You're sitting there in the Bay Area, which is probably just quite emblematic here of a lot of the issues we have with housing accessibility in this country. And I am curious, a lot of when we talk about sort of the ability to buy a home is not only, okay, getting the mortgage, it's not only being able to afford it, but a lot of times homeowners, they're competing against investors. They're competing against companies rather than just, regular people like you and me. And I'm just wondering, does that ever right-size itself? Do we ever get back to a housing market where it's just one homeowner, potential homeowner, up against another potential homeowner? Or is this really just going to be sort of this David versus Goliath battle versus big investors and bigger companies?
So it's interesting that you say that. My view is actually that homes are going to be completely almost bought and sold by corporations in the future. And they're going to play a pivotal role, I think, in that transaction. Divvy is definitely part of it. Now, the difference between Divvy and other corporations is we put the power in the hands of home buyers. So we let our customers pick out the home. Divvy then buys it for them. Again, it's the house that they've picked out, and we put out an all-cash, quick close offer. So finally, consumers are able to compete with a lot of the institutions who are out there bidding. So we give this leverage to our customers, and there are other companies that are out there in the prop tech space that are doing the same thing. So there are some folks, the core mission behind Divvy is to give access to home ownership, not necessarily provide an all-cash bid. That's a benefit. But there's plenty of brokers who are now switching to offering all-cash bidding for a lot of their consumers who are wanting to put down offers on homes in order to do exactly this, which is compete with the Zillows, the Open Doors, the iBuyers of the world, and be able to buy homes and compete against people who can offer cash, non-financed offers, no appraisal contingencies, very short due diligence periods.
Adina, how are you trying to level the playing field in terms of when you're credit checking the people that are going to be paying you rent initially and then hopefully buying the home? How are you making sure that you're getting all the right reads of them, that they're the right person to be jointly purchasing on behalf of, to be able to sell it back to them?
It's a great question. So we put all of our customers through a credit underwriting model, and the goal of that model is to just make sure that we're setting them up for success, that they're going to be able to buy back the home, that they're going to be able to make the payments, and that they're not going to move into this house and on day one feel overstretched. The majority of our customers are actually healthcare workers, so think nurses, x-ray techs, and the main issue is generally student debt. So because of large amounts of student debt, they cannot get a mortgage. For the second biggest area for us is 1099 workers. So think Uber drivers, Instacart delivery, truck drivers are a big customer segment. For them, if you don't have W-2 income, it's actually quite hard to qualify for a mortgage. So what we're able to do is use technology to actually be able to underwrite people who maybe couldn't get it underwritten by the traditional financial system. We're able to make smarter risk trade-offs and decisions in order to allow them onto our platform, where then they can build up over the course of 3 years if they're 1099, get their taxes in order, for example, to be able to then get a mortgage down the road. Now, I want to be very clear, we can't accept everyone. There are some people who apply who aren't obviously going to make it through, but our goal is to give people as much of a shot here at being able to get a home and then build up equity and savings and then be able to buy that home back when they're ready.
Interesting stuff. I'm really fascinated by your company, really fascinated by this business model, and hope to have you back soon sometime, Adina, to kind of talk about sort of any progress that you've made here. That's Adina Heffetz, of course, co-founder and CEO of Divvy Homes. Now, coming up, we're going to continue this conversation. It's really around housing inequality, and we're actually going to take a look at the muni market. Taylor, this is your wheelhouse here. Our next guest, Stanford professor and author of the book, The Bonds of Inequality. This is an interesting book here. Justin Jenkins, it came out a little bit earlier here this year. He's going to be joining us to discuss the impact and the history of municipal bonds and how it may, Taylor, have actually contributed exasperated some of the inequalities.
Take that,
out
Muni
there.
moment.
Worlds are colliding. Muni bonds and what'd you miss?
Yeah.
The worlds collide.
I'm excited for this conversation. I've never been this excited for a municipal bond conversation.
Good. We're getting you excited.
I can tell you in the tone of your voice, Romaine.
This is Bloomberg.
Let's bring you some breaking news regarding crypto. This time, Robinhood, we understand, is testing a new crypto wallet and cryptocurrency transfer features within its app. Now, it's a long-awaited move. Many have been anticipating this, but this is being uncovered by our own Mark Gurman and Annie Massa. Mark Gurman noting a beta version of its iPhone app and says that the company's work is clearly evident on some features, and therefore the software is also including a hidden image portraying a wait list for pages for users to sign up for a crypto wallet feature.
For our U.S. audience, by beta, Caroline also means beta. Beta.
The tomato
is beta.
How did the Romans say it? I bet they said it my way.
Probably. I'll save us. Let's go to a special edition, of course, today on Bloomberg Equality on What You Missed. We've really been looking and examining the bottom line impact of diversity. Our focus this week, the muni market. Stanford professor and author of The Bonds of Inequality, Debt and the Making of an American City, Destin Jenkins, and his book, argues that the history of inequality in the 21st century in America is, well, in part, the history of municipal debt as well. And Destin joins us now to discuss. So perhaps lay out the arguments. You take us back to San Francisco and I believe the 1940s through present day. Where are you seeing the connection here?
Well, first, really good to be here with you all. I think the kind of point of departure is to kind of think about the familiar story of the good and noble quality of the municipal bond market. And in many ways, that's true. Without question, the principal market participants did channel the investment savings into the infrastructural needs of cities and states around the country. But it is also true, and this is what the book shows, that the business of debt, buying, selling, rating municipal bonds, to say nothing of issuing municipal bonds, proved a powerful generator of different and overlapping inequities, whether it be the inequality between bondholders and local residents, or in terms of spatial inequality, deciding which neighborhoods or projects were worthy of investment. Of course, thinking as well about the inequality of wealth, whether it be from the upward redistribution of regressive revenue sources in the form of tax-exempt interest income. So it tries to take that familiar story to say that there's, to some extent, it's largely true, but there's also something we've missed, and that's the overlapping forms of inequities.
So when we talk about that, though, Destin, I mean, just to get to the essence of what municipal bonds are, and sort of, or rather what they're used for here, I mean, some would say, okay, you need this money, you need the borrowing in some form or another to finance basic infrastructure for a lot of municipalities. You need it to finance other ambitions that these cities and municipalities have here. Is there a way where these cities could accomplish that without basically borrowing?
Yeah, a fantastic question. And for this, we kind of have to go to a forgotten proposal during the late 1960s, which was essentially trying to figure out whether there was something structural, sort of structural bias built into the credit rating process in particular. And the proposal was that absolutely there was a bias built into it. And in part, the question was, how do rating analysts in the 1960s at least figure out what's a AAA bond or what's a BAA bond? And the proposal was that actually there's something fundamentally biased about the process that, for instance, favors suburbs over inner cities that had been disadvantaged by federal policy. And the proposal was that the market actually is exacerbating, in some sense, creating inequities. And the proposal was to actually put forward, for instance, low interest loans or federal grants directly to municipalities as a way of circumventing the kind of power dynamics of the bond market itself.
Destin, I mean, you write about it and you call it black bond politics. You say black neighborhoods were continuously deemed unworthy of debt. Now, how do you also fix that if now we understand that you cannot have that sort of racial inequality going on at this level, and you do start to really invest in black neighborhoods, you don't then create the unwanted side effect that it then becomes pricing out of those that actually live there, that you don't suddenly have this, I hate to use the turn of phrase, gentrification like we've seen in certain parts of Brooklyn, for example, that then ends up meaning what was the heart and soul of black community becomes less of one.
That's a fantastic question, and the gentrification issue really does start to come into play, for instance, in the early 1980s, where you had neighborhoods that had been traditionally redlined, new clientele or kind of professional class moves to the city and displaces older residents, and then the city responds to those new residents and what they represent in terms of revenue potential or local economic growth by way of investing in city services and infrastructure. So it's absolutely a concern, and one question is whether the bond market is adequately capable of responding to the spillover effects of gentrification. And frankly, it's a question that should be asked about federal grants and zero interest loans as well. In other words, there's no silver bullet solution to the problems of inequality that the book discusses. But I do think the book makes a compelling case that the bond market exacerbates inequities, and we should at the very least be attuned to them.
Now that we are attuned to it, where do you see, is there a city, is there a prescription that can show us how to start to turn things around?
A terrific question. I think the way I like to approach the question is not so much about a city that gets it right, but to think about the trade-offs. If we start to think about the threat of climate change and the importance of building infrastructure that responds not just to older environmental racism, but to the threat of climate change and environmental destruction, there's an opportunity, especially in the context of low interest rates, to borrow and fortify these neighborhoods to improve improve the infrastructure to give communities the best chance. At the same time, that process of borrowing to kind of protect disadvantaged communities and communities more generally should not, and here's the thing, make us lose sight of the inequities built into the system. Again, just because interest rates are low, it could quite possibly mean that interest rates prove a trap and perhaps exacerbate, again, the power dynamics that the book.
We only have about a minute left here, Dustin, and I want to leave on this question here. The general idea that banks, basically what we cover every day here on Bloomberg, that these are basically neutral intermediaries here in the finance process, basically just there to facilitate the flow of money and, of course, take their cut in the process. But at the end of the day, they're neutral. Is that real? Is that a myth, or is it real?
It's a great question, and I would just leave the viewers with the example of the NAACP and CORE, civil rights organizations who rejected that idea. How in the late 1950s and early 60s, after Brown v. Board, you still had underwriters who insisted that they were just neutral, but nevertheless continued to finance segregated education in the South, for instance. So the idea that bankers are just intermediaries is part of the myth that gets told that would see the bond market as having nothing to do with power differentials and to kind of put the blame elsewhere, if you will.
Dustin Jenkins, fascinating. Thank you so much for coming on, of course. Assistant Professor of History, Stanford University, and author of The Bonds of Inequality, Debt, and the Making of an American City. Now,
it's a good book.
A good book, yeah. Go read it. That was a fascinating conversation. Meanwhile, we want to correct comments made Friday on Bloomberg TV, where Binance Holdings is the focus of the US investigation into insider trading and market manipulation, not Binance US, which is a separate entity. It was the former CEO of Binance US who recently stepped down, not Binance Holdings. We've removed the clip online. Meanwhile, well, that does it from What You Missed.
Yeah, Bloomberg Technology up next here in the U.S.
Have a great evening, everyone. This is Bloomberg.
From the heart of where innovation, money, and power collide, in Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, the death toll by COVID-19 in the U.S. has surpassed that of the 1918 influenza pandemic, a milestone many experts say was avoidable after the arrival of vaccines. And now the U.S. is doubling down on travel requirements for vaccinated foreigners and unvaccinated Americans. Plus, Ted Lasso and The Crown steal the show, with streaming services like Apple TV Plus and Netflix racking up more Emmy Awards than any traditional television network. What's the next big thing for streaming beyond original content? We'll discuss. And Pinterest co-founders are hit with a shocking lawsuit. The plaintiff, a woman who claims she contributed critical ideas that became the foundation of the product, but never got paid. Christine Martinez joins us in an exclusive interview to talk about her case against Pinterest CEO Ben Silbermann and co-founder Paul Sciarra. But first, we have to start with Monday's market sell-off. U.S. stocks falling the most in almost a year. Let's get all the details with Bloomberg's Kriti Gupta. Kriti, what's happening here?
Well, Emily, we've been talking about this on your show. You've had record after record with only a handful of names pushing the broader index to those records. So what does it do? It creates a coiled spring kind of effect. And then you get a day like today where you see broad selling across the board. At one point, the S&P 500 was down almost 3%, Emily. And what led the charge? It was, of course, big tech to the downside. And where did the money go? It went right into treasuries. So you see yields actually going down as much as 5 basis points, even more than that earlier in the session. A lot of this has to do with simply the risk that's piling on. We'll get to the fundamentals in a second, but a lot of this also has to do with technicals. Remember I said that coiled spring? It's a shallow and shallower pullbacks. We weren't getting that reset that we needed. This is the chart that I like to look at when we're talking about drawdowns. We like to get 5%, 10% corrections as kind of the market flushing itself out, but all the way since November, we haven't really gotten that. No more than 3% today, hitting almost 4% as a drawdown, of course, from the September 2nd peak. So what was behind it? The question here is that a lot of it had to do with macro risk, really coming out of China. The Evergrande story really was the straw that broke the camel's back, in addition to that coiled spring I just mentioned. And this is the chart that I think really tells the story. You've seen that Chinese regulatory scrutiny get worse and worse and worse, to the point where from the February peak, you see the Chinese ADRs index, which is the Nasdaq Golden Dragon Index, drop 50% from its peak. We had a little bit of a bounce back, and now down again, down 51%. Emily, the question is, does the selling continue, or is this simply a one-day ordeal, especially as we go into the Fed on Wednesday? That's what's going on the macro front. Let's get to the micro with Ed Ludlow.
Well, that risk-off sentiment certainly spilling into specific cryptocurrencies. As we move into Tuesday's session, you can see actually most cryptocurrencies holding steady, but vast selling throughout Monday's session. And what happened was that impacted crypto-related stocks. You see Coinbase down 3.5%. Coinbase also, of course, scrapping plans to have a lend facility after some conflict with the SEC. We can dig into that later on. And you also mentioned Chinese ADR. Well, we saw some pressure from those different stocks, Chinese companies listed on US exchanges, of course. This is part of the contagion discussion that we've had. Pinduoduo, JD.com, Baidu, some pretty big percentage point declines, but also the biggest points decliners on the NASDAQ 100. Finally, some news breaking aftermarket on Monday. Robinhood, finally, this long-awaited feature of a crypto wallet and the ability to transfer and hold cryptocurrency. You can see Robinhood shares that actually initially risen in after-hours trading on Monday, now down a little softer by 0.5%. Emily.
All right, Ed, thanks so much for that. Meantime, the U.S. will soon reopen its borders to most foreign travelers, as long as they're fully vaccinated against COVID-19. The White House said the new measures will also involve stricter requirements for COVID testing and contact tracing. This comes as the number of Americans who have died of COVID-19 has now surpassed the number killed in the 1918 influenza pandemic. Our Bloomberg political news director, Jody Schneider, joins us now with more. And Jody, these new travel rules, not just for foreigners, but for unvaccinated Americans. What do you make of them?
Well, the White House is sort of doubling down on its trying to split the vaccinated from the unvaccinated. So it's not so much the foreign
foreign travelers and the domestic travelers having different rules. Now it's sort of everybody, right? If you're unvaccinated, you are not welcome in the U.S. essentially, and if you're an unvaccinated American, you're going to have trouble too. But what they're saying, and the airlines, of course, like this, and their stocks went up as a result today, but if you're vaccinated, you are welcome. You know, you have to prove it, and there's still testing requirements, but at the same time, it's much easier to get in. Right now, if you're an overseas traveler and you're in certain countries, including the UK, including, in large parts of the world, you'll have a lot of trouble getting in the US. Now they're saying, if you're vaccinated, you're welcome here. So this is part of the, it's almost a carrot and stick approach from the administration, right? Saying we will, if you're vaccinated, you will get benefits. If you are not, there will be prohibitions. And as you note, this comes as the U.S. is again in the midst of, really large numbers of hospitalizations and deaths from COVID. Those went way down when the vaccination rates started to go up, but with them plateauing and that Delta variant spreading, we're now seeing almost 2,000 deaths a day, and we are at that number. We've surpassed 675,000 deaths, which was the number of the pandemic in 1918. Now, of course, the nation was only about a third as large as it is now, so this is saying that, this is a different kind of scale, but still, that's a pretty sobering number.
So incredibly alarming, and there was this Brazilian diplomat that just tested positive for COVID-19 in town for the UN General Assembly. Meantime, obviously, many of the unvaccinated Americans are children, and there's not a vaccine ready yet for them. What progress has been made on getting vaccines for kids? What are we learning about the trials of Pfizer and Moderna as to when and whether these vaccines will be ready?
Well, there's some good news, I think, for parents on that front. Pfizer today said that its trials, its large-scale trials for children, those ages 5 to 11 who are now not eligible, were very, they're proving very successful, that they seem to be very, they're resistant to, they're offering a great deal of protection to the virus, and also that they've been pretty safe, that they haven't seen a lot of reactions to that. So that's good news, and we had the most famous advisor on COVID, Anthony Fauci, saying he thinks it will be soon that we will start seeing authorization for a vaccine for children. Of course, this can't come soon enough with school starting, in-person learning, going back to becoming the norm in most parts of the country, and some outbreaks occurring, again, in areas where there's a large number of unvaccinated people, but that still has parents worried, and I think a lot of parents will be very welcome. This will be very welcome news that this is coming, they hope, very soon.
All right, Jody, thanks so much for that roundup. So much news to digest every day. Appreciate it. Meantime, Coinbase is bowing to pressure from U.S. regulators and tabling plans to launch a product that would pay users interest for lending out their tokens. Coinbase is about face comes as SEC Chair Gary Gensler takes a tougher line on crypto products that may fall under the agency's purview and the platforms that they trade on. Bloomberg's Jesse Westbrook joins us now with more. So, Jesse, what do you make of Coinbase giving in here, where they, they had sort of indicated they were going to stand their ground?
Well, yeah, this is really a pretty remarkable SEC case and action. It's very unusual for the SEC to be this aggressive about threatening to sue a company before they launch something, before any actual, in the SEC's eyes, misconduct occurred. Usually they're sort of, going after conduct that has already happened. So it's a really new tack from SEC, and I think it sends a signal to the entire crypto industry that, if you were considering things that we don't like, we will come after you, and it's a pretty strong hammer to get the market responses they want. I mean, obviously, there is a situation unique to Coinbase that they're a public company, so the risk of an SEC lawsuit has, and they're U.S. based, so the risk of a U.S. lawsuit is much more, SEC lawsuit is much more severe to them than to a lot of their competitors who are sort of operating in the shadows overseas.
Is this a big loss to Coinbase in terms of a potentially big future revenue stream?
Well, I think one issue here is, this is something that crypto platforms are increasingly doing, offering yield for the crypto that is sitting in your account, much like a bank would do. And it is arguably a pretty big competitive disadvantage in the sense that if I can go to a different trading platform that is paying me just 5%, for my crypto to sit there, isn't that the platform I'd want to go to? Because otherwise I'm earning nothing. So I think that will be an issue that Coinbase will have to figure out. I mean, it's if competitors can offer you, you can just make money even if you're not trading. That's a pretty attractive option, it would seem.
All right, really interesting turn of events here. We'll see how this one plays out. Bloomberg's Jesse Westbrook, thank you for that update. Meantime, the SEC is said to be investigating video game company Activision Blizzard over its workplace practices. This, according to the Wall Street Journal. It reports the company and several senior executives, including CEO Bobby Kotick, have received subpoenas. This following a lawsuit from California's Department of Fair Employment and Housing alleging the company fostered a frat boy culture and discriminated against female employees. Coming up, the streamers reign supreme. At the Emmys, big wins for Ted Lasso and the Queen. See Apple and Netflix nabbing the biggest awards at television's Night of Nights. We'll talk about what it means for the industry with Matthew Ball, managing partner at Epilion and former global head of strategy at Amazon Studios. That is next. This is Bloomberg. The streaming industry was the real winner at the Emmy Awards. Apple TV Plus won Best Comedy Series for Ted Lasso, and Netflix's The Crown won Best Drama Series, the first time Netflix has actually won that top prize. In fact, Netflix nabbed 44 awards in total, taking home more accolades than any other network. Matthew Ball, managing partner of Epilion and former global head of strategy at Amazon Studios, joins us now to discuss. Matthew, what does that tell you? I'm sure it's not necessarily a surprise.
No, it's not a surprise, but it certainly reflects the way things have changed over the past few years. This was the first time since 2014 that HBO did not take home one of the top prizes, Best Comedy, Best Drama, Best Limited Series. Notably, HBO itself did not have any of the nominees. It was HBO Max, the Max size, that did. And then, of course, we had Netflix's first win, Apple's first win, and Disney Plus's second year with a Best Series nomination. Things have changed.
Would you say this is a changing of the guard? Can Netflix and Apple hold on to these leads, if you will?
I would say the changing of the guards happened several years ago. Netflix has often led in total nominations. Where it lagged was in the wins. But certainly if you take a look back to, I think, 2015, that was the first year in which the streaming or streaming-centric networks had the majority of nominations.
So where does that leave Amazon, where, of course, you used to work? I mean, are we seeing a consolidation here in terms of the folks who can really compete and lead the pack?
I certainly wouldn't count Amazon out. Certainly they had their first nod for The Boys, another outstanding show that was on former President Obama's top of the year list. And then separately, we had the perennial winner, Marvelous Mrs. Maisel, which did not air during the period. And so I would expect that going forward, we see more strength. But for the most part, we should look forward to a future in which HBO Max, Netflix, Amazon, Disney Plus, and Hulu do, in fact, dominate year over year, probably taking 7 of 8 nominations in every single win.
Do you think there's a quality versus quantity problem? It's as if there are so many amazing shows out there, but sometimes it's hard to find them, you know? I'm done watching Ted Lasso, and I don't know what's next.
There was always a demand for another outstanding high-quality television series, but I think what is clear is how the lack of scale disadvantages a program's shot at success. For All Mankind was an outstanding show on Apple, but it was probably disadvantaged by the fact that Apple had a very small audience, just in the same way that Ted Lasso benefits in the second year from a much larger Apple. When you take a look at a show like Queen's Gambit, one Best Limited series, one of the biggest shows of the pandemic, I would guess that had that aired on a smaller network, perhaps a Showtime or an Epix, it would not have been the hit that it was. That's a reflection not just of outstanding storytelling, but the consequence of the platform chosen.
Bloomberg Intelligence just published a report saying that Disney Plus, they believe, could surpass Netflix in terms of subscribers in 3 years. What are your thoughts on that?
I think when you take a look at the global market, we see over 750 million ex-China pay TV homes. By the end of the decade, that is probably a figure at 900 to 1 billion homes. There are many countries that have never paid for pay TV, and when they have, it's a bare fraction of the audience, Japan, Portugal. We're probably looking at a future where the largest streaming services have 300, 400, potentially 500 million households. I think it's unclear whether or not it's going to be Netflix or Disney at the top.
Now, your Metaverse fund, meantime, just surpassed $100 million in assets under management, and I know you think this could be a multi-trillion opportunity. It'll take over the current economy. How and when do you see that happening, and what sort of entertaining happens within that?
It's a great question. The CEO and founder of NVIDIA recently said that he believes that the economy of the metaverse will exceed that of the physical world. And that is mostly based on the fact that most of the future world will run in one way, shape, or form through the metaverse, much like most of the world today is dependent upon the internet. That's a multi-decade transformation, but at least over the next decade, I think we can see substantial shifts of entertainment, of healthcare, of communications, as well as many other categories such as fitness or meditation shift over.
There's so much battling now for who will own the metaverse. You know, you've got Epic and Balenciaga launching this high fashion collaboration through Fortnite. You've got Mark Zuckerberg also saying he wants to own the metaverse. And yet the vision that's painted is of a decentralized future. What will the role of actual companies be in the metaverse, and how will some of these sort of ethical questions of who runs the metaverse be answered?
I think the best way to think about this question is to compare so-called Web 2.0 with the original web. Even today, we have some of the most powerful companies in the world controlling most of what we do online. At the same time, none of these platforms is the internet. Apple is not the internet. Facebook, Google, Amazon are not the internet. They're very powerful, horizontal, and vertically integrated platforms. So in the future, the likely outcome is that we have a similar construct. There are very powerful companies, but they are not the metaverse. They are dominant participants in it. And yet if you go to the early web, it was far more decentralized. AOL at the peak of its power, Yahoo at the peak of its power, even Facebook, before many of the big tech giants had emerged, had nowhere near the control that they do today. The big hope among the decentral community is simply that the metaverse will be less controlled than it is today, but certainly there will be dominant players.
All right, fascinating. Well, I'm glad we have you to chart the path forward and make sense of it all. Matthew Ball of Ipillion, thanks for joining us. Coming up, investing in a greener future, we hear from Bill Gates and Larry Fink about raising $1 billion in corporate funding as part of a clean energy push. Those details next. This is Bloomberg. The Fed holds its two-day meeting this week before issuing its latest policy statement. We will be listening for any comments on inflation, as well as looking for signals on a timeline for scaling back monthly asset purchases and, of course, the continued impact of COVID-19. Bloomberg will bring you all the details in our special coverage this Wednesday, 1:30 p.m. Wall Street time. Meantime, Bill Gates has raised more than $1 billion in corporate funding for his breakthrough energy catalyst program. And he's got big-name backers, including Microsoft's Satya Nadella and BlackRock's Larry Fink. Gates and Fink spoke to Bloomberg's Eric Schatzker about the biggest challenge for this venture, bringing costs down in green industries.
At least a few of them, given the breakthrough technologies being developed, green hydrogen could get down to a very low price within 3 or 4 years. Sustainable aviation fuel, there's quite a few approaches there. The one that's the hardest is direct air capture, because that mainly has an environmental benefit. It's not a product, like the other three are. And so that one, I'd say it's over the next 10 years that we need to drive that down. But the other three, I'd be very disappointed if we don't see a dramatic reduction in the green premium, even in less than 5 years, because that should let us do 2 rounds of projects. The first projects, and then take the learning from those first 2.5 years and do a second round that will bring the cost down even further. And the government's, a lot of that money that's being allocated has to be spent in a defined time period. And so, getting catalysts going now is very, very timely. We need this private sector engagement. And in some ways, these private sector companies we have represent such a depth of expertise that it's going to be easy for the governments to benefit from that, as opposed to going to each company individually.
Eric, I would add one thing.
Please.
Once the technology or a project shows commercial application that we could actually fundamentally bring down the green premium, the amount of private capital that would be running towards these projects would be enormous. The amount of capital that's standing by right now looking to put money to work in these types of strategies is enormous. Now we need to make sure that we're proving it. We need to make sure that it's reliable and we can build it. And so I'm not frightened about where the money's coming from. I just want to make sure that we have the science and technology and the viability. Once we know that, the capital will be there.
Is that just ESG money, or is that any risk-seeking capital, regardless of, what the people behind it think about climate risk?
I would say within 5 years, climate is just going to be another risk factor across all investing. We may not even have ESG investing anymore because ESG is just another risk characteristic of like everything else we have. And I would say all investors, where they see an opportunity to invest in projects that will transform a society that has great upside, the amount of capital will be there. Right now, I'm talking about more of its ESG capital, but I'm very confident if we can prove the technology and the technology works, if we bring down in a substantive way the green premium, the capital will be there. And I don't care how we define the capital. It'll be capital-seeking opportunities to make a good risk-adjusted return for the investors.
Larry Fink there, along with Bill Gates, speaking with Bloomberg's Eric Schatzker. Coming up, we're going to hear from a woman who claims she helped conceive the founding ideas of Pinterest, but never got credit or compensation. In an exclusive interview, we will take a closer look at her lawsuit and how Pinterest has responded next. And let's look at what's ahead this week. We've got more tech earnings Tuesday with Adobe and Stitch Fix out with quarterly results. Wednesday, we're going to see more discussions about boosters, this time from the CDC. We're going to see what recommendations the CDC makes there. And Thursday, the White House hosts a summit with companies in the chip supply chain to discuss how to ease the crunch. Of course, we'll bring you all the details. This is Bloomberg.
edu/myoffer.
Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. An Oakland-based digital marketing strategist is suing Pinterest, claiming the founders of the company used her ideas to launch the platform. Christine Martinez says she came up with key concepts, including allowing users to create pin boards to reflect their interests, but was never compensated for her ideas. Pinterest has responded to the allegations, saying, quote, "We're proud of what we built at Pinterest and appreciate all the pinners who helped shape the platform over the years. However, these allegations are completely without merit, and we will defend our position in court." Joining me now for an exclusive interview is Christine Martinez, a content creator and the accuser in the Martinez versus Pinterest case. Christine, thank you so much for joining us. Let's start from the beginning. What are the ideas you believe you contributed to Pinterest but were never compensated for?
Sure. So first, thank you so much for having me, Emily. I'd like to start by saying that, I actually helped to create the core concept of Pinterest. I created its utility, which at that period of time was a visual bookmarking tool. Most importantly, I found the community and introduced them and brought them onto the platform, a community of bloggers, designers, folks that I'd worked with many years prior to this. And last but not least, I created the marketing strategy that helped Pinterest, sort of expand in sort of the viral way that it did, that eventually led to the mass adoption of the website.
Now, at the time, you had your own lifestyle blog, you had your own e-commerce startup. As you say, you took them to conferences, introduced them to people. What did they already have by the time you started giving their input?
They didn't have anything. The period of time in which I started working with them, Pinterest was really just an idea. It was a drawing on a piece of paper that occurred at my apartment one evening, and there was no website. It was really something that needed to be, figured out, both from its utility and beyond that in terms of its community.
You're suing for breach of implied contract, idea theft, among other things, and Pinterest says these allegations are completely without merit. How do you respond to that?
Well, I respond by saying, I know exactly what I've done and what I did at Pinterest and for Pinterest over the period of time in which I did it. And I know that Ben Silberman and Paul Ciara, they remember exactly who I am and they know exactly what I contributed. So I'm confident in my case and looking forward to continuing to work through this with them.
You say that they verbally agreed to compensate you many times. Can you tell us about those conversations and what was said?
Yeah, so we had countless numbers of conversations over the period of 4 years. This was a 24/7 venture. This was something that was being worked on constantly. And those were things that are often come up in conversation. I think at the end of the day, no one went into the situation, with an understanding that, they were going to tap into my subject matter expertise, leverage myself, my community, and my contacts there, and the years that I had established a relationship within that community. I think the idea that, you would bring someone in and not pay them and not credit them after the enormous amount of work that went into that platform is simply absurd.
Now, you were never formally employed by Pinterest, as I understand it, and you didn't ask for a contract. So why are you asking to be compensated and credited now? Why not do this years ago? I mean, the company was founded officially in late 2009. They went public in 2019.
Yeah. So I'm really coming forth right now to claim what I've earned. That's simply what I'm looking for, is just what I've earned for the work and the years that I spent developing the product. It explicit. It was known. The expectation has been there. So, you know, I just don't think that there should be any surprises from anyone about, you know, coming forth at this point.
Did you try to reach out to them before filing a formal lawsuit? I mean, did you think about that, or were they at all, were any conversations about this started before the lawsuit hit?
Yeah, that's something I absolutely thought about, and I've given a lot of thought to. I'll tell you, on IPO day, which was a really devastating day for me, you know, they sent a very loud and clear message, you know, when they didn't pay me, or even acknowledge that I simply existed. And so, you know, like I said, it shouldn't be a surprise. I certainly contemplated reaching out to Ben on that day. I actually started drafting an email. And at the end of the day, I realized on the other side of that email was a whole team of lawyers and just a lot of people that I realized, you know, it would be best for me to approach the situation in a much more appropriate manner. And that's why we're here today.
I understand you have evidence to back up your claims. What kind of documentation do you have? Do you have a paper trail? Do you have emails or texts from that point in time?
Well, like I said, we were working very closely together 24/7 for about 4 years. So I'm very confident in my case. I'm very confident in what I have. And I'm very excited to move forward and again, work this out and receive what I've earned.
Can you tell us a little bit more about your relationship with Ben in particular? You go back to college, I believe. You were actually close friends. You were a bridesmaid in his wedding. Tell us a little bit more about your relationship with Ben and your relationship with Paul and how that developed.
Yes. So Ben and my then boyfriend in college and now husband were best friends in college. They were in the same residential college at Yale University. I was dating my husband at that period of time and spent a tremendous amount of time there. So we spent a lot of time together. You know, beyond that, you know, when Ben moved from, you know, DC to San Francisco, we picked up our friendship right where we left it. And these are people, you know, Ben and Paul Ciara, you know, included. These are two individuals that, you know, came to my childhood home and opened presents with my family on Christmas morning. You know, so I think that probably says a lot about the level of friendship that we had.
There are broader questions about how Pinterest treats women and people of color. The former COO, Francoise Brockers, sued the company, settled for gender discrimination. Two black women, Ifeoma Ozoma and Erica Shimizu Banks, have publicly accused the company of pay inequity, say they were victims of racist and sexist remarks at the company. Pinterest employees have staged a virtual walkout in response to some of these issues. Shareholders have sued the company and the board over its workplace culture. What do you make of this, especially given that this is a company that serves a majority female customer?
Yeah. So look, I'll say I'm not surprised. I wasn't surprised to hear about any of those things that came out. I think at this point, you know, as you stated, Pinterest has a long, ugly history of anti-woman bias and behavior. I know how I was treated. I know what my experience was. So I wasn't surprised to hear about these things in the slightest.
And last quick question, what do you want out of this? What are you hoping for?
Yeah, I really love what I earned. I worked really hard on this product. I put my heart and my soul in it. And I think any creator that puts their heart and soul in anything expects that at the end of the day, at the very least, they'll get what they earn. So that's really what I'm looking for here. And I certainly want to send out the message that this is just not some way that you can treat creators. And I'm here to really stand behind that.
All right, well, we'll be following the lawsuit, and we do appreciate you sharing your story with us. Christine Martinez, content creator, thank you so much for joining us. Meantime, The restaurant payments company Toast has raised the price range for its pending IPO. The company now plans to sell almost 22 million shares at $34 to $36 a share. The deal could value the company at up to $18 billion. Toast software helps diners order online and in person. Plus, the payments company Stripe plans to hire dozens of new employees for its London office next year. It is part of a broader expansion in Europe as it prepares for a possible IPO. Stripe has headquarters in Dublin and San Francisco. It was last valued at $95 billion. Coming up, post-pandemic freelancing. Hayden Brown, president and CEO of the global freelance platform Upwork, joins us to talk about the latest workforce trends and the Great Resignation. Hordes of workers leaving their companies amidst the pandemic. That is next. This is Bloomberg.
Or more on car insurance.
The impacts of COVID-19 seem to be sticking around, and with it, questions about whether to prolong working from home. Companies continue to weigh when to reopen their workplaces, as well as how to attract and retain top talent. Hayden Brown is the president and CEO of the global freelance hiring platform Upwork, and she joins us now for this week's work shifting segment. Hayden, great to have you back with us. Now, as the pandemic drags on, what new trends are you seeing in terms of what workers want and what employers want?
Yeah, Emily, I think the big trend that is here to stay with us around what workers want is around flexibility. You know, whether you are a full-time employee or whether you are one of the 20 million Americans who jumped into the freelance workforce last year, it's all about working when, where, and how you want to work. And I think that's one of the reasons that freelancing in particular has taken off in such a big way. And on the company side of the house, you know, companies that I talk to are just saying, look, remote work is now part of our permanent go-forward strategy. We're figuring out how we make this a strategic asset because the war for talent has been with us for so long, and now remote work can be a competitive asset in breaking through that war for talent and reaching populations of workers that we were previously not tapping into because companies were looking in their own backyards. And that includes reaching into talent pools like the freelance economy, which has got tons of the talent that companies really need, but previously they were just not looking for because they were so used to working with kind of old and outdated ways of hiring, including, you know, on-site, on-premise, which is now, I think, proven to be, you know, very outdated as companies have figured out through the pandemic.
We've been hearing a lot about the Great Resignation. What's actually happening?
I think this is actually a peak point that's kind of culminated as workers have looked at the work that they're doing, their value systems, the trade-offs that they were making around work and life, and are stepping back and saying, wait a minute, I want something different. I want something more. And that's causing a ton of workers to not just shift from job to job, which is certainly a lot of what's going on in the full-time employment space, but also we've done a survey recently which shows that 10 million Americans are actually considering leaving full-time work and moving into freelance. So again, I think this is a peak point from a trend that was happening pre-pandemic with employee tenure shortening, with more and more workers joining the freelance workforce. But now we're in a moment that is going to be extended with a new normal that is represented by the Great Resignation, but really looks at the workplace being much more dynamic, people moving in and out of jobs and moving into freelance at a rate we have never previously seen.
So are some companies being flooded with new talent and others losing out, or are people resigning everywhere?
I think the pattern is really widespread, but where we're going to see, I think, a discrepancy is companies that really reject using remote talent as part of their strategies are going to be increasingly struggling, I think, to capitalize on where that talent is. Because what I hear is whether or not people are employees or freelance, they really want more flexibility. And that is one of the great lessons coming out of the last 18 months is people wanting those controls over when, where, and how they work. And you talk to somebody who is now being called back into the office, looking at giving up time. Maybe they were walking their kid to school or spending more time at soccer practice and really defining those boundaries differently. I think employers who don't listen to that and really are drawing firm boundaries in ways that really don't work for workers are going to be continuing to really struggle to attract talent going forward. So that's where there's going to be, I think, a challenge for employers that really don't listen to what the workers are saying they really want in terms of flexibility.
Where is demand coming from right now for freelancers in particular? And what is the supply like? What are the freelancers out there that you're seeing? What can they do? What can they provide?
So the demand is coming from really all segments of businesses. We serve half of the Fortune 500. They're leaning into this trend. We are serving small businesses, mom and pop stores. They also recognize that this is a great place where they can get talent. So the demand is very widespread in the market. And on the supply side, on the talent side, these are workers who have every type of skill, everything from web development, software development, design, marketing, translation, writing skills. So what we've seen over the last year plus is really a broad-based realization on both sides of the equation that so much of this work can be done as freelance and can be done by skilled professionals working remotely. So this has been an amazing moment, although I think the supply side of talent is still ahead of where businesses are, because talented people have known for a long time they can and will work this way. I think it's more on the business side that people are figuring out that this can be real programmatic, sustaining work for them. And that's where we're really leaning into that opportunity to educate businesses how this can work for them, how they can build really meaningful relationships on our platform with these talented individuals. It's not here today, gone tomorrow. These are sustaining ways that people can really power growth and sustainability.
Interesting. We will be watching how it all shakes out. Thanks for helping us make sense of it. Hayden Brown, Upwork President and CEO. Appreciate you taking the time to join us.
Thanks.
Coming up, the first all-civilian-led space crew made their safe return to Earth over the weekend. We're going to recap their journey and talk about what's ahead for the commercialization of space next. Meantime, the new Marvel film, Shang-Chi and the Legend of the Ten Rings dominated the U.S. box office third straight week. Disney movie benefiting there from fewer new releases from competing studios. Shang-Chi is the first Marvel film with an Asian lead and is still only available in theaters. This is Bloomberg.
you've got the markets covered.
SpaceX's Inspiration Mission 4 is back. Inspiration 4 mission, the 4-person all-civilian crew splashed down in the Atlantic right off the coast of Florida Saturday evening, marking the first time an all-civilian crewed space shuttle went to orbit. For more on the historic milestone, I want to bring in who else but our own Ed Ludlow. Ed, you and I were trying to see it on Friday night from the Bay Area, but I'm not sure if we actually saw Inspiration 4, but we certainly saw stars in the sky.
Yeah, I mean, it was a dot right up until the moment that it came into Earth's atmosphere. And remember, the Dragon is a fully autonomous system, even the part that brings it back down to Earth, that tracks its course and descent. And frankly, it was just perfectly executed. Everything that SpaceX said would happen did happen. You know, they came out 24 hours earlier and said that splashdown would be at 7:06 p.m. Eastern time on Saturday, and it was. And the crew were safe. They've gone under medical checks. They've gone under testing to make sure they're all right, and they are absolutely fine. And what's more is they smashed past that charity fundraising target for St. Jude as well.
So what's next here, Ed, in terms of what this means?
Yeah, every investor I've spoken to, every NASA official says this was a resounding success. And frankly, the biggest step forward for civilian and commercial spaceflight that we've seen. You know, it goes way beyond what Bezos and Branson achieved. And for SpaceX, this is a supply-constrained business. They have a big backlog, they say, of willing paying customers. So it's going to be interesting to see how they factor in those launches. They say maybe 4 to 6 over the next 12 to 24 months. Alongside all the other things they're trying to pull off, but a big step forward nonetheless.
All right, Ed Ludlow, thank you so much for that update. For more on the Inspiration 4 mission, the future of space exploration, I want to bring in Space Capital founder Chad Anderson. Chad, we've seen so much progress, or at least high-profile missions, in the last couple of months. What does this one in particular mean for the future of commercial travel?
Well, this one was a lot of fun. You know, we were all certainly watching it over the weekend, and it's for more or less regular folks. I mean, I recognize that it's a pretty expensive mission, but these are 4 people that had never met, sort of came together and said, you know, why don't we, you know, jump on a flight together and go to orbit. And it was just sort of fun to watch, and it felt like, you know, that you could, if your friend had a chartered space flight, that, you know, you could go along as well. So it's really accessible from that perspective, which I appreciate. And, you know, but for me, what's most exciting about this is that this is not a one-off, right? It's not like, oh, this was a successful mission and let's kick our boots off and take a rest. I mean, SpaceX has other big initiatives underway. Their commercial Starlink satellite internet is coming out of beta and launching commercially next month. Starship is gearing up for an orbital test flight, which is the vehicle that's going to take humans to the moon and Mars. You know, Elon says that we can land people on the moon in 2024, and we've got robotic precursor missions to the moon in the next few months. This is a really, really exciting time because there's so much going on.
What kind of investment activity are you seeing at the moment? I know there have been a flood of space SPACs. I'm sure there's private stuff happening on the private side. Has that picked up as a result of these more high-profile successes?
Yeah, certainly. I mean, the only reason that we're talking about space as an investment category in the first place is because of SpaceX. We've been operating in space for decades, but it's only become an investment category over the last 10 years or so. And that all kicked off with their first successful commercial launch in 2009, where they removed the barriers to entry for new startup companies. And so, you know, they ushered in reusability in 2015. They launched the first commercially launched humans to orbit with NASA astronauts in 2020, and now the Inspiration 4 mission. So all of this is really, you know, giving investors a lot of confidence, and these successes are really driving investment into the category. We've seen $200 billion in equity investment into 1,500 space companies over the last 10 years, which is up from basically zero beforehand. So SpaceX is really, you know, the key instigator and the key driver behind a lot of the innovation and investment activity we've seen.
And last quick question: there have obviously been a number of space SPACs, but you know, with excitement in any particular category, there are companies that are going to fail. There are going to be companies where there's no there. Is there a concern about that in the space industry?
Well, look, SPACs aren't going away, but they're certainly going to be restructured, which is already slowing things down a little bit. I mean, investment in the space economy requires specialist expertise. And this will become apparent as some of these shake out, some of these SPAC companies shake out and the quality rises. I am all for public markets getting involved earlier and getting in on the upside earlier, but there's this assumption that if it's a publicly traded company, then someone has done some diligence on the company. But some of these SPACs, that's just not the case. So I think the next few months are going to be interesting.
Chad Anderson, Space Capital founder. Always great to have you with us, Chad. Thank you for joining us. And that does it for this edition of Bloomberg Technology. Make sure you tune in tomorrow. We're going to be joined by Airbnb CEO Brian Chesky, Salesforce President Brett Taylor, and Chair and CEO of Revolution, Steve Case. Big show. You don't want to miss it. I'm Emily Chang in San Francisco. This is Bloomberg.
A very good morning. Welcome to Daybreak Australia. I'm Hadi Stradwatts in Sydney.
I'm Sophie Kamarudin in Hong Kong. We are counting down to Asia's major market opens.
And good evening from Bloomberg's world headquarters in New York. I'm Sherrian. The top stories this hour. Investor angst over China property and the Fed's taper timeline sparks a global stock rout. The S&P 500, though, paring some of those losses as dip buyers emerge.
The market contagion now testing President Xi's resolve as traders question how far he'll go with his real estate crackdown.
And the U.S. eases travel restrictions as COVID-19 deaths surpass the toll of the 1918 influenza pandemic. This is a picture across Wall Street. We are seeing U.S. futures under a little bit of pressure, but this after the S&P 500 saw its worst day since May. The 100-day moving average, that technical resistance level did hold, which was really interesting because we saw the last hour of trading seeing a little bit of a bounce back. Still, JP Morgan saying this is an opportunity to buy stocks because the global economic recovery will continue. Also, Treasuries rallied today, which was a little bit different from the trend that we've seen in the past month, where we continue to see falling stocks and rising yields. So perhaps signaling that today's anxiety was a little bit deeper than usual. WTI continues to lose ground after seeing the worst day in about a month. Of course, we had the broad market sell-off, not to mention that the dollar also saw the best day in about a month, given this haven demand. So take a look at the broader commodity space. GLCO Go is your function, and you can see basically a sea of red, especially being led by base metals. When it comes to iron ore in Singapore, for example, extending those declines under $100 a ton. China stepping up restrictions on industrial activity in some provinces. So we saw China really trying to tame prices. So they've been selling key base metals, including copper, from state inventories. Of course, the Fed will be watched not just for a tapering decision, but also for how Chair Powell's views on price pressures have evolved given these moves by commodity prices. But really, Heidi, it has been about Evergrande, right? Why are we seeing all of these markets so anxious today, especially commodity sector? Because Evergrande could pose a real risk, not only to, say, debt holders of Chinese Evergrande notes domestically and in foreign markets, but also because it could affect the real economy of China. Will that affect construction, the property sector, and how that's going to be felt across markets in the world given China's demand on commodities? That's really hit sentiment.
Yeah, and Sherry, what's really fascinating is about this, we've been tracking this Evergrande story like some sort of slow motion car crash for months now, right? In fact, this is a story that's been building for years, but it feels like those pressures have come to the boil. We're seeing this spillover when it comes to a wide range of assets, not usually correlated to a Chinese property market. Take a look at the Aussie dollar. We've lost about 3% so far this quarter. We're seeing net shorts build to a record now. It's a number of factors, including the RBA looking like they'll have to stay more accommodative. We've had lockdowns here, of course, as you know. We've had this phenomenal slump in iron ore prices, trading below $100 when it comes to Singapore futures. And now this spillover, this is the litmus test, right? What will Beijing do about Evergrande? And of course, we know that where China goes, Australia has huge vulnerabilities there.
And it's really interesting that in this week of the Fed policy decision, we continue to talk about Evergrande, right? So we heard from the former New York Fed President Bill Dudley say, you know what, the real estate sector, the market turmoil there, that may not really change the calculation for Fed policymakers. Take a listen.
They're not going to react to small market moves and then defer the tapering on that basis. They have to change their economic forecast. I think at this point it's really premature to reach that conclusion.
Well, what could change the calculation, we know, Sherry, is the path of COVID, the virus handling, the vaccine rollout. We have had these developments when it comes to the entry of foreigners in the U.S. The government in the U.S. will be essentially banning people that are unvaccinated to come in. If you're a U.S. citizen, you'll be subject to extra tests, but opening up when it comes to fully vaccinated travelers coming into the U.S. Sherry, we also had that good news when it comes to the Pfizer data in terms of antibodies in younger children, right, age 5 to 11. So that's going to be headed to the FDA for approval as well.
Plenty for markets to digest. Let's turn to Sophie for what to watch as we head to the market opens across Asia. Soph?
Well, Evergrande concerns touching different corners of the market. Over at Morgan Stanley, strategists there noting that there are enough catalysts that could trigger a release for markets as they navigate a mid-cycle transition amid the Fed taper and volatility in China. So staying long the dollar while being bearish emerging currencies, that is one play here to ride out the wave. A bet also favored
by Citigroup. And over at SocGen, they predict more downside pressure on Asia and LATAM effects over the coming quarters as Evergrande's prospective collapse may accelerate the downturn in China's economy. And over at Wells Fargo, switching out the chart, Eric Nelson cautioning that the offshore yuan could weaken about 2% over the next month to hit 660. The line in red on this chart right here on the combo of slower growth and more tolerance for further capital outflows, which Nelson says will more heavily influence the currency versus equities. But as we have seen, switching out the chart once more, Evergrande and wider regulatory concerns are weighing heavily on stocks in Hong Kong, which saw a broad-based sell-off on the Hang Seng Index as we saw tech, property, and banking getting hit hard, pushing the Hang Seng deeper into bear market territory and now near a support level that was established back in 2008 during the global financial crisis. Now, over at JP Morgan, Heidi, analysts don't expect a long-lasting spillover from Evergrande to banks and properties simply because regulators are not seen allowing that to happen. But the overhang still lingering here for markets as that deleveraging drive is certainly in focus, Heidi. And what an overhang that Evergrande and Sophie sure to feed into Asian trade again on Tuesday. We had that global domino-style sell-off. Let's bring our markets reporter,